Good morning, everyone. My name is Patricia Matthews. I'm the Vice Chair of Alberta's Automobile Insurance Rate Board. I'd like to welcome you to our 2019 open meeting to review Alberta industry loss experience for private passenger vehicles in order to establish our 2019 industry benchmark schedule. This will then be used in the review of insurer filings for basic and additional coverage effective October 1st, 2019. The AIRB respectfully acknowledges that we are situated on Treaty 6 territory, traditional lands of First Nations and Métis people. Before we begin, I'd like to highlight a few housekeeping items. Copies of today's agenda are available on the sign-in table. We also request that you complete the sign-in sheet if you've not already done so. And you look like a together crowd, so I presume all of you have done that already. In the unlikely event of an emergency, an alarm will sound. The first alarm is normally just an alert. Please wait for the second alarm and listen to the instructions given over the loudspeaker. When evacuating, please exit out of the room and go up the escalators that are on the right. Exit the building through the right-hand doors and continue south on 103rd Street to the muster point located in the undercover parking lot at the rear of the building. A washroom is located just outside of these doors, and additional washrooms are located at the end of the hall across from the escalator. The codes for the doors are men's 37852 and women's 25837. You don't have to write that down. They're posted on the wall near the exit to the room. Phones, please to silent or to mute. If you have to take a phone call, please be respectful of everyone's ability to hear and take it outside. Meeting will be conducted in a respectful, professional manner with consideration for everyone's time and focused on the mandate of the AIRB review. As such, I would like to ask the board to keep questions until the end of the presentations, and I will make presenters aware when they have 5 minutes left to finish their comments, so you either can continue your presentation or leave space for questions from the board. We will take a short 10-minute break following Oliver Weinman's presentation and another one this afternoon with a planned lunch break between 1:45 and 1 p.m. We ask that you return promptly and quietly if we have to start without you. We've scheduled this meeting to run no later than 4:15 p.m., although it may complete earlier depending on presenters' schedules. The AIRB's mission is to independently regulate automobile insurance rate programs and educate consumers to ensure Albertans have access to a robust automobile insurance marketplace. Therefore, the discussions we are having today represent important work that will affect just under 3 million drivers and 68 insurance companies licensed to write automobile insurance in Alberta. We have a different sound system this year than last year. In front of you, you will see that you have the microphone system with a red button. In order to be able to record you properly, we ask that when you start to speak, please press the red button. Board, if we have multiple buttons going at the same time, I'll clear them all and I'll identify you individually so that you can press the button and we can start recording again. Clear? Awesome. We'll do, under the Insurance Act and the Automobile Insurance Premiums Regulation, the Automobile Insurance Rate Board is required to conduct an annual review of automobile insurance trends and premiums related to basic coverage and additional coverage for private passenger vehicles. As part of this process, the AIRB is holding this open meeting to hear from stakeholders. We advertised this meeting on our website in late June and issued notice to stakeholders. The purpose of today's meeting will be to receive input to assist the AIRB in analyzing industry experience in order to develop industry benchmarks for insurers and the AIRB to use in the development and review of rate filings. According to the legislation, the AIRB must consider industry-wide loss costs, administrative expenses, profitability, and any other matters the AIRB considers appropriate. Today's open meeting will not address commercial coverage or complaints against insurance companies or the insurance industry. Presenters and presentations that stray into any matters beyond the mandate of the AIRB's review will be ruled out of order by the chair, kindly, and will be asked to refocus their presentation. Only those parties registered to present will have an opportunity to speak to the board members. Only members and representatives of the AIRB may ask questions of the presenter during the open meeting. Members of the public or other presenters will not be allowed to question presenters. If you are a member of the public or you have specific questions, you may approach staff during the break, or feel free to email your questions to airb@gov.ab.ca. This meeting forms one piece of the process through which the AIRB will arrive at its industry benchmarks for the rate filings that will be posted on the website prior to October 1st, 2019. This meeting is being recorded to allow the AIRB to review the comments made by each presenter. And as such, we ask if you're having conversations in the audience to please keep it to a minimum so that the audio continues to be clear for those listening in the future. Copies of today's presentations and written submissions will be available on our website, airb.alberta.ca, following this meeting. In addition, we will upload a recording of today's meeting prior to August 31st, 2019. So if you want to listen to it again and experience it again, feel free to do it. With that being said, I would like to start by asking each of the board members to introduce themselves. And Bill, we'll start with you.
Oh, me? My name is Moore, Bill Moore. I'm a consulting actuary working out of Calgary. This is my second term on the board. I was on the original board starting in 2004. Thank you.
My name is Jay Jaworski. I'm a loss adjuster with Charles Taylor Adjusting in Calgary. I've been on this board for 2 years now.
Morning, James Cumming. I'm the consumer representative for the board. Prior to that, I had 2 terms as a general board member, and I'm a lawyer from Calgary.
Good morning. Good morning. My name is Chris Daniel. I'm serving board member since 2011, and my last term, and a retired insurance executive.
Thank you. I'm Patricia Matthews, Vice Chair with the board. I've been on this board for 366 days now, along with Jay. And I'll take the moment now to introduce you to our members of staff. Actually, I'll ask you to introduce yourselves because I know you don't necessarily get the opportunity. Lori, we'll start with you.
Lori Balfour, Executive Director.
Good morning, Vivian Cao, Senior Manager Actuarial.
Morning, Christine Zhao, Senior Rate Review Analyst.
Kimberly Curran, Manager Rate Review.
I'm Hayden Borlis, Rating Analyst.
Thank you. And at the end, we also have our consulting actuary, Ms. Paula Elliott. With that, I will ask Paula to start us off with her presentation. While you're getting set up, I'd also just like to add for the record that regrets are sent from Mr. Henley in the Superintendent's office and our Chair, Charlene Butler.
Okay. All right. Good morning. So this is a similar presentation to what I presented last year this time. We were talking in the introductions there how long people have been with the board and doing rate reviews and industry analysis, and I was doing work for the Alberta former board prior to 2004, looking at industry stats and setting loss trend rates. So for quite some time, I think we're probably into 18, 19 years doing that. So not new at this. In terms of what we're going to cover today, we're obviously going to go through the benchmarks that have been presented in our report. And these benchmarks are used for rate filings, for measuring industry performance, for looking at the rate level needs for the grid, coming up with loss development and loss trend benchmarks based on the industry data. And one of the things that when we do our work, which is because we're using industry data, we don't have the advantage of companies, that companies do in looking at the causes of changes to the industry data to try to understand why the average claim cost is, in this case, increasing, and why the frequency rate might be changing. And so some of those ideas of causes that have been submitted, they're really quite helpful because it's also not just insightful for possible future reform changes that might be necessary, but it's also understanding why costs might be changing, why these patterns are changing. And even if we look at the historical data that we measure and what we're estimating loss trend rates might be, are these causes, will they change the future patterns as well? So the input that's provided by the various companies through this process is quite helpful, and I hope to learn more as the day progresses, as other presenters provide their input. On to the next slide. Here we're not really seeing, this is the written premium. There's really no change between the total claim costs, the split between basic and additional. Either the written premium is slightly higher for the basic coverage, a little bit less for the additional, but not much change. And then on to the next slide. For the basic coverage, we are seeing a slight, very slight increase on the accident benefits, going from 9% to 10%. And I just want to sort of point that out because we'll talk about accident benefits a little bit later, and some of the changes that are being observed by the companies that might be driving this shift to higher proportion of the claims costs in AB. The next slide. 4 is just the breakdown. Again, really little change between 2017 and 2018. This is just a summary slide on changes in economic conditions. And one thing to point out or noteworthy is the decline in the unemployment rate in 2018 and 2019, both at 6.6, a decrease from the levels in 2016 and 2017. And one of the companies pointed out an association with the unemployment rate and the bodily injury and accident benefits claims costs. So hopefully that's a positive sign there. The next slide is just graphically the unemployment rate over time. Clearly it's shifted up, and we see a more recent decline towards the tail end. And I'll move on to the next slide, the investment rates. I'm going to go back one. Here we have a lot of uncertainty. We had the investment rates moving up, as it shows graphically here, and slightly going down. Then we've had a number of recent changes. Nonetheless, the stock market tanking yesterday 800 points, and the U.S. Fed reducing the interest rate by a quarter of a percentage point a couple of weeks ago. So interest rates are, and that's not what we do predict, but I think for the economists that do predict it, that we have to rely on, there's a lot of uncertainty right there in coming up with a benchmark. And then in terms of the industry benchmarks, on in the next slide, 8, that we do consider, many of these are input directly, whether it's the ULA provision from GIZA, the health cost recovery that's provided to us. But I'm going to walk through each of these items this morning and state what our assumptions are that we're providing as guidelines to the board as a recommendation. In terms of the ULAE, again, this is important to us when we review loss trends. So the loss data that we use includes both the allocated loss adjustment expense and the unallocated loss adjustment expense. And we find that over time, companies may have a shift in whether they use more allocated resources for claims handling or they're outsourcing. And so when you use the total cost for claims handling, you eliminate that shift that can occur for companies between ALAE and ULAE. So our loss trend analysis is performed including both components. And in terms of the value that we use for the ULAE, that's the next slide. They're provided through GIZA. They apply these factors to the accident year. And we do note that there is an increasing pattern over the last 3 years, going up from the 8.5, 9, then 10. Perhaps someone can have some insight on that one, but we do see that. On to the next slide. This has not been updated since our prior semi-annual review on the 6-month data through to June 2018. The current benchmark right now is 60%, a factor of 1.6. And again, this is based on industry data. We will be updating it when the 2018 data is available. But insurers are expected to support their own catastrophe adjustment, but in terms of industry data, this is what's being, or what was measured. On our next slide, 12, we just really had just a few comments on that it seems reasonable, the 60% until the new data is available. And Intact has noted that there's an increase in more catastrophic events in the recent past, and that 16 of the 15 events in Canada in the last year was in Alberta. And on the next slide is, again, it's still with the data used to the end of 2017 on developing the catastrophe factor. But you can see, although 2017 was low at 1.240, probably hard to see there, but over 2012 to 2016, that average was fairly high compared to the prior 10 years. So it definitely has shown a rise in the more recent years, and we'll see what 2018 tells us. And the next slide is on the investment income rate. So the current benchmark using that was produced for the semi-annual review is 2.82%. It's based on Government of Alberta's forecast that was provided to us in January of this year. And we have provided a preliminary benchmark of 2.84, again using what the Alberta government has provided to us in March. And we haven't had this time last year we did have an update to the forecast, but we haven't received one for to update for our presentation today, so there's no change there. But on to the next slide, I think it's pretty noteworthy, if you haven't become aware yet, that there was a change in the rate filing guidelines here in Alberta that effective in July. The board's rate filing guidelines require the insurer to discount the cash flows using an expected investment income rate using their own data, their own expectation. Again, as I said earlier, I think there's a lot of uncertainty. I'm curious to see what the economists do forecast, given the U.S. decline at the end of July from 2.5 to 2.25%, the quarter percentage drop. What I was able to find on media reports were indicating that there was no rush that the Bank of Canada was going to reduce the rate as well, but anticipated eventually that would occur. So we'll see what that is. But again, that is an industry benchmark. But for rate filings, companies are expected to provide their own estimate of their expected investment income. On the next page, in terms of input, IBC had indicated they would find a risk-free rate of 1.7% to be reasonable, which of course is lower than the current benchmark. And that was based on the government 3-month T-bills, Government of Canada, for 2019, as of March 2019. And the values that we have provided to us are based on the forecast. We're looking at the forecast for 2020 and 2021, and 3-month and 3-year bond rates for Alberta. And in fact are not that different from the Government of Canada. There's just a 0.1 percentage difference in those forecasts. So it's still a wait and see, and we hope to update that when we get new information from the Alberta economists. And on to the next slide, health cost recovery. The board's position has been to accept the government's most recent health cost recovery assessment as the benchmark, which is currently 6.7%. And when that would get updated into the new year, the beginning of 2020, that would get updated at that time. On the next slide, we've just indicated that IBC finds the position, or the provision to be reasonable, and as they have in the past, would recommend that a higher provision be used because there's been a pattern of increasing the health cost recovery, and that's despite the drop from the earlier provision at 7.04 declining in 2019. But there has been a history of increasing that provision that they have noted. Operating expenses. So the board's position has been to accept the latest industry operating expense as published by GISA. The current benchmark is 26.6%, and it's based on GISA's 2017 expense report. And in this case, the general expense component is based on a percentage of the earned premium, and the other components, taxes, commission, are based on a percentage of the written premium. We do not have the 2018 expense report available, so there's no change from the current benchmark. We'll review the new 2018 data that will become available hopefully in typically October. It should be released. And one comment that we had was IBC suggesting, as they have in the past, that the expense provision should be based on a percentage of the earned premium for all components, not with taxes, as for example, as the percentage of written premium. And on the next page, just a chart showing you what those expense provisions are. Total commissions 12.5%, and the tax, of course, 4%, and then the balance for other expenses and general expenses totaling the 26.6% as provided by GISA. Okay. So that was the easy part. Now we're, oh, sorry, I jumped too fast. Profit. Well, it is easy too. It's been the board's position to use the 7% of premium as their position, so that's what we have presented here. And there were no suggested comments from any of the submissions to change the 7% level to a different number. So, sorry, that was the easy part. Now we're on to loss development, which is more challenging. So again, we're looking at aggregated industry data, trying to estimate what one internally at a company might call your actuarial reserve or your IBNR. and it's the provision that we're trying to estimate will bring the reported losses, which are the case amounts reserved plus the paid amounts, to an ultimate loss amount level. And individual insurers, they can have patterns that are substantially different than this aggregated industry data upon which we're developing patterns. So it's certainly possible that individual companies, when they do their own assessment, or even if you did it individually, did each company individually and added them all up, you would not get the same number because there are differences within how that data is aggregated. You get different patterns. And also, this year, unfortunately, 2 large insurers had very substantial changes in their development patterns, so it added a fair amount of uncertainty to the estimates. We do have access to the individual large insurer data, and so we considered removing that data, adding it in, and what our findings would be without that through our studies. But my point being that it makes it more challenging when there are substantial changes by large insurers in their development patterns. On to the next slide. So when we review or we develop our estimate of the ultimates, we also look back to see, how did that compare to our prior estimates? And for the 2013 to 2017, generally we're in line with our prior semi-annual review that we performed in June, or using the June data, and with the exception of bodily injury. And then also in the case of, bodily injury, the losses that emerged in the second half were generally less than what we were seeing from our prior review. In terms of the estimates that we have come up with, like thinking of this on an aggregate basis, IBC has indicated that they're essentially the same as our estimates. GISA is similar with the exception of bodily injury. GISA's estimate is lower than what both IBC and ourselves, Oliver Wyman, have presented. And we didn't receive any comments that from the insurers that they objected to. They either stated agreement or did not state an objection to our estimate of the ultimate loss amounts. In terms of the ultimate claim counts, one of the things we've observed is that, and I noted earlier, that there was a small, modest increase in the bodily injury loss costs from 2017 to 2018. So, trying to understand why is it just a modest increase? Was the frequency declining and the severity still offsetting that, but not very much? So, or what is happening? Why is that change modest versus what we've seen in the prior years? And unfortunately, this instability of this claim count data that we have here has created a little uncertainty in trying to understand what's going on with frequency and severity in this change. So, perhaps I'm hoping we'll get some more comments from the industry on that, what they're seeing to explain the 2017 to 2018 being somewhat like a modest increase, a little bit more than flat. And how, trying to understand causes of this change and how that might explain this flatter change from 2017 to 2018, and is that a new direction for the trend rate moving forward? So it's unfortunate that the claim count is not helpful right now with sort of the problematic reporting. So yeah, we're going to talk about that a little bit more as I go through the presentation, but I think that's really key for everyone to understand what is driving this small increase from 2017 to 2018, and is that indicative of a future new pattern? So in terms of, I think I'm on the, I just want to say one more thing and go back to 26, slide 26, please. I'm just planting a little seed here. So with this flat change from 2017 to 2018, and when I've looked at the data, wondering, I mean, there's a couple of things, and I'm just talking, you know, to help share information and insight, and I hope we get more of that later. There was a decline in the unemployment rate that I noted earlier, that it went down to 6.6%. Is that contributing to this flatness that we're seeing? And one of the companies has submitted that there is a stabilizing from 2017 to 2018 of the percentage of claimants that are subject to the MIR, the minor injury reform cap. So it had been on a decline, how many claimants would be subject to the cap. So is the percentage of claimants subject to the cap stabilizing? Is that contributing to this flatness? And is perhaps the unemployment rate also contributing? So I just want to sort of state that, and we'll, as we hopefully walk through this, the rest of my presentation, that will come through. So the next slide, 27, are the causes. So a lot of insurers provided some insight as to the causes for the increases that have been observed, really starting in 2010, 2011, as loss costs have been rising quite dramatically. So that, of course, as we just said, the changing injury mix, so fewer claimants subject to the minor injury regulation, more claimants with legal representation, the injury types that are overriding the MIR, excessive disbursements to experts, and a lack of judicial resources for timely trial dates, and different court cases, Sparrowhawk, McLean versus Palmer, have also contributed to that, which leads into the next slide on the minor injury reform amendment. So this was introduced in May 2018. So there's, you know, really not enough data at this point to measure if there, you know, if there was any impact of this amendment. And the sort of common view from what was submitted by the insurers is that really it's of, you know, unable to provide an estimate or a limited value, and they don't see it materially decreasing the portion of claimants that would be meeting the minor injury definition. Okay, and oh yeah, and accident benefits, as I mentioned earlier, it's taking a larger proportion of the total basic claims costs. And Aviva had a few comments on that, which, interestingly, that there are more claimants escaping the treatment protocols, and that it's increased from the 4.67 up to the 13.3 in 2016. So, you know, that would be a driver of the severity going up, and then more claimants having legal representation, using it to support, or suggesting that it supports their bodily injury case. So 2 reasons for the increase in accident benefits. And 2 other key items. Cannabis introduced last October, last fall, the legalization. Of course, there's, you know, insufficient data within the December 2018 data to know if it's had any impact on claim frequency. So there's been, you know, no adjustment made for that in any estimates of 2018 data, or changes to frequency or severity rates for that. And another item that's really noteworthy in Alberta is the comprehensive theft claims, the dramatic rise since 2012, although it has plateaued more recently, but Alberta is really shockingly high compared to Ontario. And we have some stats that we'll show you at the back of our slide deck here. But one more point before we leave that is IBC has implemented some initiatives to combat this fraud related to the theft and in 2019 and hopes to continue these into 2020. So, you know, it's possible if as we look forward and we think about that future theft frequency levels, will these IBC initiatives help us reduce that theft frequency trend rate? You know, is that something that should be considered? Okay. So this is our estimate of the ultimate claims costs for bodily injury. And in the color chart, it's probably pretty hard to read, but the bottom blue is the paid losses, the gray is the case reserves, and the red is the IBNR. And in the data, our estimates from 2016 year-end data to 2017 data, we had some very large increases. We're seeing that 2017 slight drop than what we estimated last year at this review, and 2017 is modestly more than 2017. So that's the pattern that we're seeing. We are hoping 2017 and this change to 2018 continues, but there's a lot of uncertainty due to the data, the changes, and then the pattern that we've seen in the past. Again, I talked about, the next slide is on the reported claim counts. And we have seen quite a rise in the more recent reporting by GISA of claim costs, some of these jumps by accident year. So each of these bars are the annual reviews, our estimates at that time. And even for 2017, we see a fairly large jump in the claim counts, but we do see a decrease in 2018. And so got to question, is this decrease in the number of claims that are being reported, is that accurate? Given the pattern, I just apologize there, given the pattern that we've seen it rising, why is it going down? Change in pattern causes you to question it. And the next slide is just sort of to tag on to the prior one, and these are the estimates of the ultimate claim counts that we have. And due to the patterns that we're seeing, we are seeing that 2018 might be slightly less than 2017. Although I had the opportunity to hear a presentation by the transportation experts yesterday, and they did indicate that there was a decline in the number of crashes in 2018, so maybe this is true. So that would be good. Our next slide is really just a ratio of the case reserves to the the paid to the case reserves. We see an uptick in 2017 and 2018 there over the prior period, so we'll keep our eye on that. Our next, moving into loss trends. Okay, weather. I know we have lovely weather yesterday and today, but some of the companies, TD in particular, reported that they do see a correlation in their stats between weather events, temperatures below -5 in Edmonton, more claims, and in Calgary, the amount of snow, more claims. So, I think it's noteworthy as an actuary to be aware of weather conditions. It helps really more identifying and understanding your data, any high points. So I thought that was interesting that they were able to provide that information from TD. And again, TD, in terms of unemployment rate, they were able to observe a correlation in the unemployment rate in AB and BI claim costs. And I referenced that earlier that there was a decline in the unemployment rate, and is that possibly associated with the small change that we see from 2017 to 2018? I am on to slide 38. So our loss trend analysis, IBC does their own analysis, which is appreciated that they provide that, and we are generally similar. We are a little bit higher on BI and lower on lower on AB than IBC. And feedback from insurers indicated that they found the trend rates to be generally consistent with what ourselves and IBC were putting forth. But of course, the concern with that, these trend rates are quite high, and the ongoing concern, and certainly the last several years, is the annual loss trend rates being greater than the annual premium increases, and so will there be continued deterioration due to that effect. The next slide is just a brief summary of what our trend rates are and how they compare to the semi-annual review. Changes, just a few of them, PD and collision, are a little bit lower than our prior review. Comprehensive, we haven't updated because we're waiting for the new catastrophic data, and then we'll incorporate that into our analysis. So I'm jumping over to slide 41. We're on to loss trends in detail for bodily injury. Certainly the comments from the insurers that they're continuing to see the increase in the bodily injury claim costs, contributing to the higher trend rate, need for reforms to temper this. And IBC has commented that they see the trend rate becoming less steep starting in 2015. And again, in terms of the trend rates and any adjustment, there was no suggestion that the MIR amendment should be incorporated to adjust the trend rates. So here's, again, hoping we'll get some more feedback with the other presenters today. Aviva provided some really helpful information regarding their changes in the percentage of claimants subject to the cap, the minor injury cap. And so declining from the 82% in 2012 down to 67% for both 2017 and 28. So this reduction that we've seen, or that Aviva has observed in the number of claimants being subject to the cap, that would contribute to this upward severity trend because fewer claimants are now limited to the cap amount. So there is not that if you're a non-minor injury claimant that you would get, that's changing dramatically, or if you are a claimant subject to the cap, it's that shift of more claimants not being subject to the cap is causing this steep upward severity trend. So understanding, is it coming to a point of saturation that in this range of 2/3 of the claimants would be subject to the cap? Is there any more room for that to decline, or will it stabilize there? And if it stabilizes there, then perhaps we'll see this really steep severity trend start to flatten a little for us. We still have costs up here, but they just won't be going like that. They'll be a little flatter. The next couple of slides, I have a frequency slide for bodily injury and a severity slide, but I'm uncertain of the claim count data, so I'm going to look at the loss cost slide. That's 45 there. And you can see with the red line, that is our fitted line. It's unchanged from our selection that we had from our prior review. but it's a little steeper, our line, than the more recent points data, that there is a little bit of a flattening happening from 2015 onward, so, and certainly quite low from 2017 to 2018. Property damage, I'm going to jump down to slide 49. We have a small decrease from our trend rate that we had from our prior review. Not keeping, it has not been keeping at the same pace as the bodily injury trend rate. So accident benefits on slide 51. So some of the comments that we received, the IBC attributing the increases to the economic conditions, greater legal representation, and claimants seeking care for longer. Cooperators sort of also seeing increases, but just a little bit of a timing difference. And Aviva noting that there's a stark difference between the medical claim cost increases versus the disability increases, 189% versus 27%, which they suggest implies over-treatment by the claimants. So any changes in claimant behavior where there's going to be more over-treatment, care for longer, all of this will contribute to the higher loss trend rates that we're observing. And again, here in this case, go down to slide 54 on the loss cost AB trend. In contrast to the BI that I just talked about briefly there, you can see our red line is below the data, and we're not quite as steep as what we've been seeing for the more recent couple of years on AB. I'm going to jump to collision. Not a lot to say here. Slight decrease in our trend rate from our prior review, 2.5%. Comprehensive, as I mentioned, we have not updated, but I do want to point out on slide 63, the theft, the frequency rate for theft, which clearly it was high back in 2006. Something, economy beat it down, and now it's turned back up again. And hopefully the efforts that IBC is alluding to with their campaigns to fight fraud will help beat that back down again, but it's really, really steep. And the same with the next slide, the severity for theft, continued upward. And then the next slide, the loss cost. Of course, you put the two together, and it's a really, really steep curve. And then the last slide that I mentioned earlier, and we had something like this last year, so if you remember it, you'll probably not be in shock. But when I look at Alberta, and it is a claim frequency rate of 0.4 per 100 vehicles in Alberta and 0.14 in Ontario for 2018. That's really dramatic. Okay. That's it.
Thank you very much, Ms. Elliott. We very much appreciate you taking all this concise data and breaking it down into easily digestible chunks. Some of us more than others, I think. I'd ask the board now, are there any questions that you have for Ms. Elliott? Bill, any questions?
No.
Jay, any questions?
No.
Jamie?
No.
Chris? No. Thank you very much, Ms. Elliott. If I could ask you one question and ask you to keep it concise, is there one particular trend that you think it is most important that the board consider going forward?
Yes, and I will be as concise as I can to be accurate. I think both the bodily injury trend rate and the accident benefits, we're seeing more recent changes in patterns that a shorter-term view would give us a different future trend rate. So both those coverages, I think, considering, based on feedback that we hear today, on bodily injury and AB, future trend rates for those coverages, yeah.
Thank you very much, and thank you again for your time. Up next, we have the Insurance Bureau of Canada. We're going to take a 5-minute break so that we can give the folks at the Insurance Bureau of Canada time to get set up. So folks, if you want to stretch and not wander too far, in the next 5 minutes, we'll get going with the next presentation, please. And you know I will be on time.
Go.
All right, folks, thank you very much for being prompt and back in on time so that we can respect the time of our presenters. Next, we have the Insurance Bureau of Canada. Ms. Power and Mr. Foster, I'll leave you to introduce yourself for the record, please, and thank you.
Thank you very much, Madam Vice Chair. Yes, I am Celeste Power. I am the Western Vice President for Insurance Bureau of Canada, and with me today is Trevor.
Trevor Foster, Policy Manager at Insurance Bureau of Canada.
Yes. So, thank you everyone for having us here today. We continue to appreciate the collaborative working relationship that we as IBC, the industry, and the AIRB have, and we look forward to working together to get the market back to healthy and competitive rates. As you know, the AIRB plays an important role in ensuring consumers are protected and that insurers remain competitive and stable. We look forward to the full powers of rate approval going back to the AIRB in the coming weeks. We're going to focus the majority of our remarks here today. On the data provided by Dr. Ron Miller, which is broadly in line, as we heard from Paula, with those of Oliver Wyman and the General Insurance Statistics Agency, or GISA. All the data shows that it has been an incredibly difficult few years for auto insurers in the Alberta market. In 2018, insurers weathered over $450 million in underwriting losses. Loss ratios remained at an unsustainable position of 86%, and to make a bad situation worse, both actuaries, Oliver Wyman and Dr. Ron Miller, estimated that total claims costs will continue to increase year over year by 5.8% and 6.5% respectively. And as we all know well here, things are just getting more expensive and a little bit more complicated. Cannabis has been legalized and edibles will be legal this fall. Experiences from the US states have shown that legalized cannabis will have an impact on claims. Vehicles are becoming much more tech heavy. We're now essentially driving little computers, very large computers. We have the little computers in our pockets. And autonomous vehicles are coming to a street near us soon. In fact, some have already arrived. Trevor tells me he was in one last week. He's a bit braver than I. Severe weather also continues to hit cost insurers heavily on the property side. And comprehensive claims data shows that it's impacting auto insurance as well. Furthermore, studies estimate that this trend will only worsen in coming years. And of course, thefts here are up higher than they have been in the past, while plateauing, they're still much higher than the rest of the country. In all, the insurance industry is currently in a crisis, losing hundreds of millions of dollars, and these issues have begun to negatively impact our broker community and most important stakeholder of all, Alberta drivers. I will now hand it over to Trevor, who will walk us through each of the cost drivers.
There we go. Fantastic. Thank you, Celeste. So we're just presenting a bit of an overview, of course, of Alberta's auto insurance cost drivers, just to really, kind of drive the point home of over the last 6 or 7 years, what have been the main cost drivers. So, as mentioned, this data is all from Dr. Ron Miller. So starting with accident benefits claims, the increase on a per vehicle basis has been substantial, 8.1% per year between, that should have said 2011 and 2018, my apologies. And as has already been talked about, the increase has been driven almost entirely by an increase in severity. But on an actual per vehicle basis, we're still only talking about probably $28 roughly $4 a year. So it's been a large increase in relative terms, but in actual dollar amounts, this has certainly not been the primary cause of rising claims costs. Moving on to property damage, as Celeste said, vehicles are of course becoming much more complex, and it seems like every new vehicle now being sold, has a backup camera or lane keeping assist, sensors everywhere. So this is leading to an increase in severity. So what we of course have seen between 2011 and 2018, there has been an increase in severity, roughly 3.1% a year, and as you would expect, because this technology is meant to cause fewer collisions, we're seeing a slight decline in claim frequency. So the net impact of the increase in severity, decrease in frequency, roughly 2.1% per year per vehicle. So slightly above the rate of inflation, but certainly not, out of control over the time period. Collision claims costs, as expected, similar story to property damage, higher severity, slight decline in claim frequency. So the net loss cost increase was 2.7%, roughly kind of twice the rate of inflation. Inflation, we know, historically has been about 2, but it's been closer to 1.5 in recent years. But again, we're not talking about a significant increase over the time period. So collision claims have also not been, and for that matter, vehicle damage claims have not been the primary cause of increase in claims costs. Comprehensive claims, again, as Celeste mentioned, and as everyone knows, we're seeing an increase in severe weather frequency and severity, and that's very much borne out in the data where, so the average claim size has been increasing, an average 4.6% a year, but we're also seeing an increase in claim frequency. So over the time period, it's been almost 7% per year, but it certainly hasn't been a straight trend because it peaked in 2016 after the Fort McMurray wildfires, and 2011 was a relatively low year. So we haven't seen that same straight, consistent increase that we've seen in other coverages. So it's been, $65 a car roughly, but it has not been the same consistent increase that we have seen among certain other coverages. So this of course brings us to bodily injury claims. So BI was the single largest increase per year in both relative terms and in dollar terms. And as has already been talked about, this has been driven entirely by the increase in severity. So, Paul Elliott, of course, already talked about how it's been an increase in severity. Ron Miller found the same thing. Giza has found the same thing. So everybody who has looked at this has found that the trend is unquestionably because the average claim size has been increasing. So over the time period, it was an average of 9.1% a year, almost double digits, and claim frequency was stable. And over the next year as well, Oliver Wyman projected, as has already been mentioned, trend factors of 7.5%, and Ron Miller projected 6.6%. So even though there has been a slight moderation between 2017 and 2018, these costs, of course, can change significantly because I believe it's probably only 5% of the 2018 figures been paid, and the rest is all reserved. So those can change significantly year to year. But neither actuary seems to think that this trend is going to be slowing. Celeste.
Thanks, Trevor. Sorry. So ultimately, what we learn from the data that Trevor just focused on is that while costs are rising, certainly pretty much across the board. Yes.
When we sent that, I'm not sure how that happened, but category name should be bodily injury, not category name. May have been evident, but just so everyone knows.
I was doing that for suspense. No, so ultimately, we've seen that the biggest cost driver year over year continues to be bodily injury, or category name in this case. Of the total increase in claims costs between 2011, the year that the trend began, and 2018, more than half the increase, 53%, is due to rising bodily injury claims costs. Those facts are clear. Everyone agrees on the data. We have a BI problem. A 2012 closed claims study found that certain injuries the medical literature considered to be minor are settling for greater and greater amounts. These injuries were intended to fall within the minor injury definition, as they do in other jurisdictions. However, they have not, and again, we have a BI problem. Data from Giza, Oliver Wyman, and Dr. Miller all confirm that the BI claim size has been increasing rapidly since 2011. The previous government, even though they did not use certainly language that we felt was strong enough, they reformed the MIR definition because they also thought there was a BI problem. There isn't really another conclusion that I think would be possible to find here. I think I can say that every single person in this room would agree that consumers need access to affordable and available auto insurance. However, what we have seen over the past couple of years, and what we can see from the data provided by the actuaries, affordable and available auto insurance in Alberta is at risk. Availability of non-mandatory products has shrunk significantly over the past year. And while not one insurer, wants to raise premiums on their customers because they do actually want to keep their customers, they're competitive. But if the root cause of the problem isn't fixed, premiums will ultimately follow the claims costs. To ensure affordable and available insurance, we must work together, government, industry, the rate board, and stakeholders on a solution that fixes the significant problem we have, rising bodily injury costs. With the rate cap expiring on August 31st, the insurance industry has been working to find other solutions to deal with the BI problem and stabilize rates for consumers. I know I sound a lot of doom and gloom all the time. I know it's only my second year here, but everyone I've spoken to in between has been like, oh my, crisis, crisis. And it's true, we are in a crisis. But there is an opportunity here as well. There's an opportunity to actually fix this system and have it work for consumers over the long term. So we see there are essentially three options available to us. We have the status quo, which I know some stakeholders like. However, ultimately we're here to protect consumers. The rate cap expires, premiums follow claims costs, availability starts to pick up, but it's slow, and the crisis continues. We have a two-step approach. We can work to implement very quick changes, stabilize costs in the short term, really, strengthen up that minor injury definition, but ultimately, as we've heard, this will essentially see claims costs stabilize, but not lower. So we'd have to be looking at broader reforms to the system. Or three, let's do broader reforms to the system now. Work to implement larger changes in the system in the short term that focus on the care of accident victims, give consumers more choice in the market and the products available to them, and give drivers more options to control their premium while removing the excess costs from the system. While some may have thought the rate cap controlled premiums for consumers, a recent report that we commissioned from M&P shows that by the year 2023, the short-term reforms, so option number 2 that we talked about, the easy ones, the small ones, would have actually controlled premiums better for consumers than a rate cap that the previous government put in by almost $100. Good public policy is fixing the root cause of the problem, not implementing caps that will ultimately push the problem off down to the road for consumers for tomorrow. This is just an estimate of how the short-term reforms would control premiums better than a rate cap. We suspect that broader reforms would bring forward an even better picture for the consumer. The data here is clear. The data here is clear. To improve affordability for drivers, reforms to the system are needed. Clearing costs out of BI will save consumers money. Trevor's now going to speak to the regulatory environment and the grid.
Great. So first, we wanted to take a moment to commend the AIRB on its recent decision to increase the simplified filing threshold from the old 3% over 1 year to 5%. This is something we've been very much in favor of. We are supportive of. At IBC, we have done many studies of many jurisdictions, both in the U.S. And in Europe, and what we find is just that, well, when insurers have more latitude to be adjusting rates based on claims costs, based on trying to increase market share, that consumers ultimately benefit. Consumers see more rate stability and ultimately more innovative insurance products. So definitely wanted to take a second to mention that. However, we do believe that there are additional reforms that will result in even more benefits of competition for consumers, and additional benefits such as more innovative products and more discounts. And notably, IBC recommends the transition to a use and file rate regulation framework under the authority of the AIRB. And last, but certainly not least, the grid vehicle loss experience. So. Ron Miller does, Ron Miller does an analysis every year of the grid vehicle loss experience. So We decided to only put this in one slide because we could have done multiple slides. The real story here is that based on pretty much any metric, the grid is not working as was intended, and it's not working all that well. Between 2012, which we chose 2012 instead of 2011 because that was the first year that the AIRB increased the base premiums for grid vehicles, loss costs have increased 5.3%, 3.5, almost 4 times the rate of inflation. Over this time, loss ratios have averaged over 100%. As of 2018, the underwriting loss on grid vehicles was approximately $56 million. It actually averaged $56 million as well over the entire span. So over this 7-year period, there is roughly $400 million, almost $500 million of underwriting losses for grid vehicles. The most recent estimate is that each grid vehicle results in an underwriting loss of approximately $351. 13% of the industry's total losses were due to the grid. These are a whole bunch of stats. The whole real takeaway from this is that based on really any metric that you look at, the grid, it's no longer working as intended. But the biggest stat that we found, so between 2012 and 2016, the AIRB increased grid-based premiums between 5 and 8%. And as would be expected, the subsequent years saw a decline in the market share of roughly half a percentage point. Because of course, when the premiums go up, fewer drivers are captured, you see a downward trend in the market share. But in 2017, the largest ever increase occurred, which of course, which being 10%. But instead of a decrease in the market share, we saw an increase. So the current market share is approximately 6%. So a 10% increase was no longer enough to make the market share go down, which is to suggest that, even if it had been in line with more historical amounts, we would have seen an even larger increase. So now, we have a situation where all the metrics are showing that it's not working and the grid vehicle population is actually increasing. So IBC recommends that the AIRB review the current grid framework to see what works and what does not, alongside reviewing the current rate regulation framework.
Thanks, Trevor. So, sorry about that. In conclusion, the auto insurance system is currently in crisis, and it is impacting local businesses and the 3 million drivers who count on it to get to and from work every day. BI remains, from all the data that we can see, the biggest cost driver with the biggest annual increases. Ultimately, excess BI costs need to be removed from the system, while of course balancing consumer protection and care in the event of an accident. The insurance industry does see that there's an opportunity here. It isn't just all doom and gloom. We have an opportunity to work together, work collaboratively with the AIRB, with the government, and with other stakeholders on solutions that will improve affordability and availability of the market. We believe that Alberta drivers deserve that. With the rate cap expiring on August 31st, 2019, we strongly urge the AIRB to use its expertise to help government and industry introduce changes that will improve the system. Thank you very much for your time today, and we look forward to taking your questions.
Thank you very much, Ms. Power and Mr. Foster. Members of the board, are there questions? Jay, do you have any questions?
I'll take Jay's question. Well, you refer to a transformational product. Can you expand on that? Are you talking about legislative changes or changes in the actual policy wording or the intent of the policy?
Yeah, absolutely. So I don't know what it is with me and this button. What we're looking at here on option C is we know that we can do quite a bit under option B to take out some quick costs from the system. Reforming the minor injury definition and putting it in line with other jurisdictions and prevailing medical literature will help stabilize costs. Putting PJI in pace with inflation will stabilize costs. But at this point, because unfortunately no concrete action has been taken for over 4 years, a lot of costs have built up in the system. So we can't do a lot but stabilize costs with those short-term reforms. With the long-term reforms, the broader reforms, what we're hoping to do is focus more on care, less on cash in court. That will remove the excess bodily injury costs from the system while providing consumers with the care they need. Ultimately, a lot of details need to be worked out, of course. We have some ideas and suggestions, but we'd like to be discussing those with other stakeholders and the government and industry. But ultimately, we want more choice for consumers. We want them to be able to have more options that they can use to protect their premiums, and we want to peel back some of the BI costs that we've seen increasing over time.
Thanks. I want to be able to figure out what the AIRB takeaway is from this, because we can't legislate, okay? We can work with government, we can try and protect consumers, but basically everything that was suggested is a legislative change and not a rate board change. So I'm just confused, or if you could clarify, if you can, what our takeaway is today.
Absolutely. I think that the AIRB plays a very important role in the system. I think that you have a lot of expertise on what has been seen over the years. I think that you have a lot of expertise on what you're seeing in the filings that go forward to you. In previous discussions with the previous government, we would hear more data, more data, more data, more expertise, more expertise. You have that expertise. You've seen what's happened over the years. So this is why we do like to bring these things to you, because we believe you have the expertise that could help us in making this case to government. We also do have a couple of recommendations in here that I believe are squarely within the AIRB's current mandate, which is reviewing the grid framework. The grid has continued to be a problem over the years, and to look at more flexible ways around rate regulation to increase competitiveness. But ultimately, it's hard to come here to a rate board and talk about claims costs increasing without pointing to some solutions, because I do get told a lot of very doom and gloom, and it's nice to bring some solutions forward, and I do believe you actually have the expertise to help us.
Thank you. I think this has been a very difficult 2 years for all of us, and we've seen it coming, unfortunately, and here we are today, as maybe you say, in a crisis mode. So we have to move forward collaboratively, and I totally agree with that. Just a couple of comments. Number one, I think the grid, when it was initially implemented 2004, 2005, seemed to be working. It was working in those days. And yes, there's no question that it needs an overhaul, but is it not working today because of inadequate rate? Is it not working because of availability? Have you got any insights into why it isn't working today?
Well, so as you mentioned, so like the grid was brought in kind of 2004-ish, and so you're saying that it was kind of working then, but ultimately what you're seeing is that the grid is, of course, it is a subsidy for high-risk drivers. So, I mean, whether we think that, whether you think that it kind of is working or not, in our opinion, it's that this is ultimately borne by the province's good drivers. So it's, I mean, the market share is now kind of back up to 6. If you think about it, 6% of, as we saw, I don't think we had in here, we included it in our submission, I believe, or we certainly have in past years, that loss costs per vehicle, I think for grid drivers are like 3 times higher than they are for non-grid drivers. So whether or not, I'd say that our opinion is that there's no reason why the province's good drivers should ultimately be having to, bear the cost of that. And 6% of the market paying very subsidized rates isn't really a sign that it is working.
And I would just add, I would just add to that. I think that what the grid ultimately tries to do is to put protection in place for high-risk drivers. I think that everyone would agree that there are certain drivers that fall into the high-risk category that probably don't deserve to have to pay these premiums, or that they can't because, they're young drivers, they're new drivers to Canada. However, people that are just choosing to drive poorly and unsafely should not be subsidized by good drivers. That is our ultimate belief. And ultimately, what we see is the grid is essentially just the third cap in the system. It's just another cap. So if we can do more things to, we want to protect the consumer. We certainly want to protect that at-risk driver that does not deserve to be paying more. But we should be looking at things that we can do to, keep prices competitive versus ultimately capping them. That's our overall view.
Yeah, okay. And I agree with that. I think that where I was coming from was living through the 2004-2005 era, we saw that the, I'll call them the bad drivers or whatever you want to label it, caused some of the real major issues and caused the reform, together with BI, together with a whole bunch of other issues. But that was certainly one of them, and that certainly hit the media. And it makes me nervous to see, I don't want to go back to that era. And so I think we need concrete solutions on how to review the grid, and where I was coming from is, do you think it's rate, or is it availability, or does it need an overhaul? And that's where I'm coming from.
Sorry. Yeah, so to answer your question, this is something that we also included in our submission, but didn't include in the presentation. So one of the things that Ron Miller does for us every year is estimate like just how rate deficient is the grid. And his most recent estimate, I believe, is that if by 2020, based on current trend factors, the average grid street premium would have to be, I think it was either 35% higher or 44% higher. I forget. But significantly higher than it is. So certainly a major part of it is rate, absolutely, because, you know, as we've seen over the last 7 years, that grid compulsory loss costs went up, 5.3%. So it's certainly a cost problem, absolutely. But of course, the thing is that you can't just, keep trying to increase the premiums following the increase in claims costs. Eventually you have to kind of, take a step back and be like, all right, what are we trying to do for, what's the real public policy goal of this? Because one thing that we've looked at is that, we haven't been able to find other jurisdictions that have a similar framework. Atlantic Canada, of course, has like sort of certain risk-sharing pools, but the market share is much smaller, and it isn't the same kind of subsidy as you see here. We looked, all throughout the U.S. You don't see this either. So part of, our recommendation is that what is the real public policy goal of the grid? And, seeing now increasing costs, increasing market share, more, high-risk drivers being subsidized doesn't seem to be, like fulfilling what perhaps back in 2004 the original public policy goal was.
Thank you very much. Thank you so much for your presentation. Folks, it's 10:21. We're ahead of schedule, so I'm going to give us 4.5 minutes to stretch so that we can have the folks from the Facility Association prepare for their next presentation, and we'll continue on through there to lunch. Thank you. It's now 4 minutes and 25 seconds, just so you know. Lovely. And we will fold Mr. Jaworski in when he gets back. So I'd ask you to introduce yourselves, please, for the record, and we'll let you take it away. I'll warn you when you get to 5 minutes. Thank you.
Good morning. Thank you. My name is Saskia Matheson. I'm the President and CEO of Facility Association. With me here today is Sean Doherty, our CFO and Senior Vice President of Actuarial. And just to up my own personal stress in the day, we also have in the room Mr. George Hardy from Cooperators, who is the president of our board of directors, and Karen Dyberg of Dyberg Insurance, who is the Alberta broker representative on the Facility Association board of directors. So you'll forgive me if I'm, just a little more stressed than usual. If we could, so we have some brief items. The Facility Association, one, we're really pleased to be here today. I want to continue in the tradition of my predecessor, Dave Simpson, of coming to the board to share information. For me, it's also a return. I was mentioning to Mr. Moore, I was here at the 2004 rate board hearings and have been attended a number, wearing a number of different hats. But one of the things that's always impressed me about this event and this organization is the sharing of information between the parties and the board for the purpose of coming to a better solution. And so from our perspective, which is fairly unique, and I'll go into that in a second, I wanted to cover really 3 items. First, a general introduction and around the Facility Association in Alberta, and I promise there will not be a quiz at the close. But also, we want to talk about recently the risk share pools, what is happening with them in Alberta, and why it is occasionally making us wake up in the middle of the night. The second is, and I know as the Vice Chair mentioned, this is not the meeting around commercial, but there have been some developments in commercial that are of interest for the general market. And so they go beyond the issue of what are the commercial factors to what is happening in the marketplace generally. And that is why we raise them. And then, yes, value-laden terminology, who would ever say we need to be unreasonable? But in terms of a range of reasonability and why we continue to advocate for a range of factors, a range around benchmarks to make room for, and I liked, Madam Vice Chair, your term from the mission of the board, a robust market for the benefit of consumers. I noted the board's mission, and I was pleased to hear the board's mission. It is not actually dissimilar to the Facility Association's mission, which is really, and first and foremost, obviously, to ensure availability of auto insurance for those who are required to purchase it. It's nice when your mission or your mandate is set in law. It kind of closes a lot of debate around what it might be. But we really have taken as our mission the promotion of that through a stable, competitive marketplace. And because we have this mission, it gives Facility Association quite a unique perspective on the market. We are looking at the market, looking for it to be healthy, looking for it to be competitive for the benefit of consumers to be able to find insurance at their choice in a marketplace that is prepared to write them. And when we see issues that are beginning to call that into question, that's when we want to bring these facts, these issues to the attention of the board. So the quick recap, there should be probably music in the background when one goes through this, but because all of the members of the board they will have heard this before, but bear with me. We do have really two main areas that operate within the province of Alberta. The first is the farm. It's not a great acronym. It has nothing to do with farming. The Facility Association residual market is what I would call the traditional residual market. It is the one we operate through 3 servicing carriers in the province, a set of rates that are the same. They are rates which are in fact adequate or intended to be adequate to cover the risk and both the risk, indemnity risk and the risk of capital of the industry that supports them. These are rates that are submitted to the board and approved, and generally speaking are higher than standard what we call street rates for similar classifications. In the Facility Association residual market in Alberta at the moment, there's around 2,000 private passenger vehicles. It's not a large portion. It tends to be, when you look at the graphs later on, it's the tiny blue line at the bottom. It's very small in terms of market presence. But it is in fact augmented by a much larger component, which are the risk share pools. This is in Alberta private passenger only. It includes both grid and non-grid business. And as we were looking at recently, no, we'll come back actually, sorry, on terms of the grid business and the percentage. I'll come back to that. These are written at companies' rates. So this mechanism works as each company writes the business on its own rate, on its own paper. And as far as the customer is concerned, they are having a policy with cooperators, with Intact, with Allstate. The company then in turn transfers 100% of that risk and premium to the residual market, and we share it all back amongst the companies, and the net loss, and it is definitely designed to be a net loss, is shared by each company based on their market share. And we clear that through every month. So every month there's a large, I believe, Sean, your term is a large amount of sloshing back and forth between companies, but always netting to zero, always carried on the company books. And I mention this specifically because it's important that the risk share pool is understood as a closed loop system. The money that it costs to run it, the money that is paid for claims, the money for premium, all nets back to the industry. It all goes back into the same bucket. In our, that's the back and forth. No, sorry, go ahead. Sorry, Sean. This is, right, we talk about it shared back and forth. We are governed by a plan of operation. The plan of operation has effectively the status of regulation in the province. So when we make changes, they're approved by the superintendents. So our whole operation has not a governmental, but a regulatory status, and is, if for those of you who desperately want to read more about the plan of operation, I know I do, but you can see that document available on our website at facilityassociation.com, and then I'll ask you to move forward. Thanks, John. So in our spare time, we also do run a number of other functions on behalf of the industry. The first is the Underwriting Information Plan with the lovely acronym UIP. We're working on something better if we could get to it, which has to do with, in these days of data, of ensuring market availability through the availability of quality underwriting information about risks. It is a growing new area and takes up a fair amount of our time these days, but it is definitely 2019, 2020 forward. It is not the era of the old, look them in the eye, look them sideways, see if you like them, yes or no, I'll write them. We are living in an age of data, and data is crucial. We run an organization that qualifies really as a phone number called the Market Availability Plan for individuals who need to access insurance and can't through a standard form. They can call the number. We get very little traffic through that organization. Most insureds who are looking for insurance will go to a number of the other bodies. I know they call the AIRB. I know they call the IBC. Oddly enough, the Facility Association not being the name that immediately brings to mind access to insurance. We also run only in the Atlantic provinces, the uninsured automobile funds, and in a couple of them, the judgment recovery as well. And again, this is old claims that before the days of uninsured motorist, and they were handled by the industry, and the FA in its governance and oversight function manages those. So if we talk about the size and market availability in the pools, if we go to the first. We wanted to show you this graph. I'm a big fan of graphs. I confess I'm a visual thinker. These graphs are based on the Oliver Wyman data. We didn't get into which trend factors, whatever. Let's go straight to the benchmarks. Where are we and where have we been in profitability in the industry? The red line shows the target benchmark loss ratio for industry profitability at 66.6%, which is generally acceptable. And what you see every time that blue line pops above it is that the industry is losing money. And the industry has been losing money in Alberta private passenger since 2012, and it's been cumulatively losing money. Now, there are we can go into the trends and the why. Our concern from the perspective of Facility Association is what impact does that cumulative lack of profitability have on market availability for customers? And so if we look at if you at any point, if you look at, for example, once we get into areas like 2016, 2018, a 20% rate inadequacy at the industry level is $1 billion in premium that the industry is shortfall. That's on an overall all-in. So when we get those kinds of lack of profitability at an industry level, these are not rounding errors. These are big business decisions, and businesses will take decisions and need to take decisions to protect themselves. Let me just, right. So if we look at the next slide, this is all of the residual markets combined in terms of our share of the market. In the old days, the prior to the introduction of the grid and the pools, you would see the residual market was just the blue line. And in fact, yes, we were part of the crisis back then that led to the grid and the various pools and the jump of large percentage of the market in the facility association. The introduction of the pools in the end of 2004, what you see is stacked all together is the residual market. And in that year, the total, so the blue is the farm, the green is the grid pool, and the orange is the non-grid pool. And altogether, that's what we would probably refer to as, or you'll hear referred to as the gray market. The grid pool has actually was dropping through the first set of those years, and we reached kind of a nexus point, if you will, just in 2011 and 2012. And I think from the perspective of just a couple of years after that, you could say, well, it might be variability. Numbers change from year to year. But what we definitely see is a rising proportion in the industry of business being sent to both the grid pool and the non-grid pool. In fact, just pulling the most recent numbers that we had available. So for example, in 2018, oddly enough, the grid pool dropped by 5%. In 2019, we're projecting it's going to increase by 22%. And in 2020 by 8. We do these projections based on actual company data to us about what they are intending to place into the pool. They are required to tell us what their plans are going forward. The non-grid pool, we saw an increase in 2018 of 12%, in 2019 of 14%, and in 2020 we expect a 4% increase. So that's that number heading back. And what does that number mean? Well, it means obviously some things in terms of your view of the industry profitability, but it means a concern for us in that it speaks to the market appetite, the willingness to write that business. And if all the mechanisms work together and work as they're intended to work, it's okay for the consumer. But when the market mechanisms stop working as they are intended to work, it becomes an issue. Just further to this, yeah, no, absolutely. The back to the chart. We're going crazy. Okay, that's okay. Wanted to point out that those numbers altogether now place Alberta in third place in terms of the size of the residual market in North American markets. We do point out it's not really a race you want to win. There may be, the US numbers tend to be a little bit behind, so if there's a growing residual market in the last couple of years, you might have slipped back to fourth place, which would be great, because the US numbers are only up to date to 2015. Nonetheless, it's still we would prefer that number to be somewhere around 2.5%, 3% at the highest in order to really be a sign of a good, robust market. If we go into the next, thanks. The farm portion, which really is the original old style, was designed to allow underpriced segments in the market to be rated at an adequate price. The prices in the farm are intended to cover the cost of that business. And in the old world, you had just the farm and the regular market. And people could go, they wouldn't like being at the Facility Association residual market, but they were guaranteed a spot to be insured. And as the industry went through ups and downs of profitability, that's where it was, again, a closed loop. The introduction of the risk share pool is designed to provide temporary capacity for systemically underpriced portions of the market. So for example, a new class or a young driver class is often the case that ends up in the pool. Why? Because the industry doesn't quite know how to price it. So it is a great place to share that risk instead of one company having to take the risk of that class on. They share it with the industry until the industry as a whole gets an idea of how it should be priced. We actually see that a little bit with things like when the various ride-sharing businesses came out, or sometimes the smaller delivery. People go, it's private passenger, but I'm not really sure it's private passenger. We're going to toss it over here until we can figure out what to do with it, and then take it back on their own book. What the risk share pool is not designed to do is to handle a systemic, long-term general underpricing in the industry. And that's what we are seeing in Alberta. And what tends to happen are things you don't expect. For example, we've had a number of conversations about why isn't the grid pool and why isn't the non-grid pool at capacity? Why aren't companies using the full 4%? I told you I was a visual thinker, so we go to the graph. In a general company pricing, you're that big blue, normal distribution of business. Your average loss ratio smack in the middle. And you see that line that shows that little tiny bit up at the top end? That's the business that you don't want to keep on your own book because the average loss ratio for that portion of the book is beyond what you can price it for. So you put it in the pool. The pool has been around since 2004. Companies are not non-mathematical. They've worked very hard to figure out what business is the business that they should cede to the pool, what business is they keep on their own. And as various things happen in the industry, the shape of that normal distribution will sort of bump out at the top as things go in. And so you'll find business goes into the pool and it comes out again, and the world works as it should. When the whole industry is systematically underpriced, you get the red curve. Everything moves forward. And in fact, what companies should theoretically do is take that whole 10% that now, and granted this is an illustration, but they are based on some industry averages. And so at that point, if 10% of your book really should go into the pool, how do you figure out which 6% you keep and which 4% you move? Now you have to spend a ton of time trying to figure out what of that big new lump that is unprofitable is the worst of it that needs to go in the pool. Some companies are doing it, and we are absolutely seeing growth. Some companies, frankly, probably throw up their hands and go, I need to put the whole thing in. That's the problem I am now. But it is not working, it is designed. And there are some risks with that because companies will start to take action to protect themselves from the risk at the front end. And that is what we are concerned about. So we did try and look at some data because we're all about data here. And so we looked at this, what looks like a really bad EKG, and it is our attempt to see if we can have a look at what the uninsured motorist population is. Unfortunately, it's almost impossible, not almost, it's pretty impossible to find stats on people who, by definition, are hiding from the system, right? They're not putting their hands up going, count me, I'm uninsured. So there are a whole bunch of proxies that we use. In this case, we tried to see if there was a correlation between uninsured claims and collision. As you can see, the correlation is really stellar. So we can't see any pattern here. There's no answer. We did look at whether there were police data. There tend to be spikes in police data, tend to correspond more to blitzes in enforcement than it does. And other than that, we don't like the fact that there's a lot of rumor around this right now. We do not believe from what we have seen that the numbers are anywhere near what some of the various rumored press amounts of 30%, et cetera. That's not reasonable from what we're seeing at all. There may have been a 30% increase in the number of uninsured drivers, but that's a very small number to still a very small number. Nonetheless, it is something that it is our accountability, our responsibility to keep looking at, because any increase in uninsured drivers means that the mechanism isn't working as it should. So because I'm, want to go from, like the Celeste, who was here before, from good news to more good news, commercial and interurban fleets. So it is absolutely a growing concern for us, but also of interest to the board in today's discussion, because it points to how is the industry looking at their profitability in the market, how are they feeling about how things are going, and oftentimes when private passenger is in a bad way, commercial does well and balances it out, and everybody goes home at the end of the day and they're still okay. Unfortunately, there's no solace in that regard. We've noted, as you see, the risk share, the facility association, that commercial business is now the largest interurban. In fact, that's that big blue slice. That's the largest part of what we write in the farm, is interurban. The next is motorcycles. The interurban book, if we go to the next, as you see, the written premium has jumped in 2017 to 2018 from 8.8 million to $29 million in premium. And if that wasn't bad enough, we're also seeing a serious deterioration in the performance of the book. So it is something we are looking at. We point it out because it is a problem for the industry. We're working with the industry on a 4-point plan. We're auditing fleets. We're reviewing large losses. But we note it for the board's concern as you look at areas that are affecting the market. I was very interested when Ms. Elliott mentioned during her presentation that, of course, there is a lot of uncertainty in predicting the future. And I always like to say here that, I have a lot of respect for actuaries. Some of my best friends are actuaries, but it doesn't matter how many decimals we put on the math, we're still actually predicting what's going to happen to tomorrow, which means it's an uncertain science. And so the more we predict the future, the more we have to realize that we're going to be wrong. The question is, how wrong are we going to be, and can we narrow the focus of that? It also matters about who takes the risk of predicting the future. And it is our view that it is the companies that should be taking that risk, or because they take the risk, they should have a fair amount of latitude in the predictions that they make. These are estimates, so we want to, and we would, again, and we've mentioned this, my predecessor mentioned it, and I think we've been mentioning it for years, that the annual review, the benchmarks, in our view, should all include ranges around them that permit companies some latitude even around the benchmark. Today, we wanted to focus just on the issue of the rate of return. That is an item that has been under some discussion. More graphs. One of the points we make in our submission is the board has set its benchmark based on the Alberta Treasury returns. And unfortunately, those forecast yields have not actually been all that accurate, either on the 3-month Treasury basis nor on the 3-year forecast. And it's a little hard to see these graphs, gray and blue. They're very stylish colors, but maybe not the most in your face. They really, I think the numbers below really tell it more. They've been, the forecasted yields were higher than actuals in 53 of the 60 months in terms of the 3-month, and in 44 of the 60-month in terms of the 3-year forecast. If you go to the next graph, this is my personal favorite. These are a whole bunch of different outfits, all of whom are very good at what they do and expert in the field of forecasting, from CIBC, RBC, BMO. These are the range in their forecasts of the yield. To think that we can go, it's going to be 2.84, and give to companies that certainty that that's the right number that we should be dealing with is simply not, I think, reasonable under the circumstances. So our recommendation is that the AIRB, in setting the benchmark around yield, actually do a plus or minus 1 point on either side of their projection of their benchmark in order to allow the companies whose capital is being put at risk in this prediction to be able to, in fact, take that prediction on their own shoulders. Go to the following. So I mentioned, and I actually wanted to, I know I've been given the 5-minute, which is now the 4-minute mark, but one of the board members asked a question about, in the last presentation about the grid and whether or not is the grid doing what it should do. And as I keep mentioning people, I'm very old now. I was here in 2004, and I remember the debates, and we talked at the time about, even then, about what is the purpose of the grid. And there were really a number of camps. There was a view that it was meant specifically to provide affordability for young drivers, and that was its purpose. There were others who said it was a cap to provide on high-risk drivers. And a general view that it was to provide simply a cap across the entire range of pricing, which was why it had components at the -15, -16 range. If it was only meant to do the other two, it wouldn't have had those grid rates down at the bottom of the steps. The comment I would have looking at what we see now in the industry is whether or not you viewed it as successful in 2004, it reflected a view of a sophisticated classification system in 2003 and 2002 when it was developed. 2019 is a very different world, and there is a lot more sophistication in rating and, in fact, in what is available in the market and, in fact, what is available to the government. There have been huge issues with the grid over the years. I know because I've had to program a few systems to try and capture it. There are issues within it that are internally inconsistent that should be addressed even in the short term, but it really doesn't reflect what companies are able to and the regulator is able to classify. And so it puts on us a very old style cap. And that's why, in our view, you see more and more business at the, what you call the -14 and 15 end of that cap that has got a very horrific loss ratio, because the companies now understand what drives the rate that should be charged for that business. So forgive me for answering a question that wasn't posed to us, but we like to add information. It's our value add in the equation. So these are the three items we really wanted to raise today. There are issues in the risk share pool. You can no longer use the overall percentage in the pool to tell you whether or not the market is healthy or not. The mechanism is not intended to work in this environment. Secondly, there are items happening in the market beyond private passenger that need to be taken into account in looking at the private passenger market and the health. And finally, that the more scope the board can give to companies to react to their own circumstances and make their own predictions, the better off the consumer and the industry will be. Thank you very much.
Thank you, Ms. Matheson and Mr. Foster. I always appreciate a test of my ability as chair to decide whether slides are appropriate or not, so good on you on that. And thank you for answering a question that we don't have to ask and making that concise. So I think you've done a great job for somebody that said they were nervous. You did wonderfully. Board, any questions? Chris, do you have any questions?
Just a couple. Thank you for answering that.
You have 35 seconds, so
35
I'll let you
seconds.
ask those, and then if we run out of time, members, I'd ask that you submit questions to Ms. Matheson and Mr. Foster in writing via email so we can continue our agenda.
You mentioned, and I know it's not really part of our jurisdiction today, is the commercial. The only comment that I would make and ask you to clarify it is that the commercial is not subject to the cap, okay, as we know. So are we talking about the commercial inadequacy of rate, or are we talking about availability? And I'm going back to my previous question. Is the PPV, or the private passenger, driving the commercial submissions to the farm, or is it another reason? Do you have any best guess on that?
And it absolutely is going to be a best guess, because at this point I'm speculating on the decisions of companies. But you're right, there's no cap on commercial, and in fact, in a perfectly operating market, all you would see is the price of that business would go up. and we wouldn't see a larger portion in the farm except for a small period of time. So why are companies choosing to vacate the field, if you will? And I think it is absolutely possible that it is a general concern about the health of the Alberta insurance economy generally. However, it's never a simple answer, and we also have an issue of growing U.S. liability concerns on interurban fleets, and we ourselves know, and we do have a plan in place, that Facility Association's fleet program was designed for the borderline fleet, not for 200, 300 interurban transports. We're not equipped to deal with that business, and we are concerned that we might be being taken advantage of. So we are digging in and reworking on that front to make sure that the price will be sufficient, that nobody will choose to come to us because we're the best deal in town.
Thank you very much. Mr. Doherty, I apologize for abdicating your responsibility in this and applying it to Mr. Foster. So while he was in the background working, he didn't even know about it. Thank you so much for your time today. We appreciate it. And Board, we're going to move on to our next item on our agenda, which is our consumer representative, which is Mr. Cumming.
That was my time. No, I'm just kidding. I got graph envy from that last presentation, so I'll try and keep this a little looser, but there'll still be some stats in it. I'm going to just go through my role and what it should be and what we've been trying to do. The rate board itself is responsible for providing basic and regulating basic and additional coverage in Alberta, and the provision of auto insurance information to enable consumers to make the best decisions. So we don't legislate, we're independent, we accept input, we provide feedback, and we use legislative framework around us. What brings me here specifically is that the Minister of Finance appoints a consumer rep, and that turned out to be me as of last year in July. As I mentioned, I was 2 terms as a board member, and then took this role on. It's been a unique experience for a personal injury lawyer from Calgary. There's been a lot of eye-openings and a lot of great discussions and conversations. Before I get into the actual report, I need to thank the AIRB staff and Chris Daniel for being fantastic in assisting me through this. So basically the background is our vision is to provide accessible, equitable, and sustainable insurance for all Albertans. This has to be done because insurance in Alberta is mandatory. So it's not a situation where you have a $10,000 policy in Montana and nobody's real worried about regulating anything. It affects every single family in Alberta for the most part. So according to the ministerial directive, we provide feedback to the minister's office each year, and part of that feedback is the consumer representative's report. How did we go about this? We hired somebody else to do the survey for us. I'm half kidding. In the past, we had a lot more direct involvement. This year, we went to a group called Yardstick. To be completely transparent, we had some logistical issues with getting things together and whatnot as far as approvals, so everybody in here can probably relate to that. But it turned out to be an interesting diversion from what had been done in the past. What was done in the past was personal interviews, random phone calls, focus groups, and what we tried to do was updated to Facebook ads and some random media calls, and to get a statistically significant amount of people in the proper demographics. And it worked. I think that Yardstick did a great job, and our staff worked hard at compiling everything. One thing that will be a little different about this year's presentation is, and this isn't in the report or in any of the slides, but if somebody's on social media and they decide to click on taking a survey, they want to say something. It's not that they happen to pick up their phone and they're, you know, halfway through dinner and they're going to answer 14 questions to be nice. So it does, I don't know that it skews anything, but it gives some pretty honest feedback. And the people who went online and did the survey, there was 639 of them, those people actually wanted to provide feedback. So that is interesting. And then there was 200 other phone surveys that were done. They were the same. The demographics that came out were very, very good. The locations that came out were very, very good. And by that I mean they were statistically relevant. So we had 150 people from Calgary, 150 people from Edmonton, 150 people from smaller centers. And that hopefully created a reasonable overview of what Albertans were thinking. Some of them were young, a little more were old than young. There was 50% were over 55, 30% in the 18 to 34 range, and 20% of the people were 35 to 54, so they were too busy working to be filling out the forms. The gender breakdown, excellent, 56-44. You're going to have trouble doing better than that on any survey. And I mentioned the location already. So what we're trying to get at is what consumers think and what consumers want, which breaks down to affordability, stability, accessibility, and service from the industry. So affordability, that can be broken down into one word, that's premiums. And the question that we came up with after noodling around for a bit was, do people agree with the statement that automobile insurance premiums are fair and reasonable in Alberta? And this is a complete two-edged sword, because 47% of the folks either had moderate agreement or high agreement, and 51% of the folks had low agreement. I don't know what happened to the other 2% of the folks, but it is a very cut and dry analysis if you look at it. And if we were doing it again, I'd probably put in a few more categories to kind of see whether there's a bell curve or just a box cut in half of people who are happy and people who aren't. So who's concerned about this, and what do they do when they are concerned? We get to consumer inquiries, and the rate board takes calls, the IBC takes calls, the superintendent takes calls. People try and call their minister if they're really fired up. But in Alberta, there was 2,500 inquiries regarding insurance last year, which sounds like a big number, and it is a big number until you consider our population. And I don't know whether those numbers were broken down if somebody phoned 6 times, whether they were an individual call or exactly how that worked. But 60% were with respect to claims, 20% with respect to or 30% with respect to affordability, and 10% was other. So on the premium side, pretty good review. On the claims side, more concern from consumers. So how does Alberta fit in a national perspective, and how does it fit just in looking at, if I'm an average homeowner, what do I pay? Well, in 2018, my average was $1,316 per policy. In 2017, it was $1,251. Obviously, a lot of that's got to do with the ministerial order, but since 2004, the average premium has only increased on a 1.6% basis. We included a provincial premium comparison, which to me and to our group was important because you'll see graphs and you'll see stories in Maclean's or various newspapers or whatever online about how people pay less in very small provinces and whatnot. But when you look at what people are paying, and the way that they did the benchmark was to take it on your after-tax dollars spent, break it down to a percentage. Alberta was 3%, Ontario was 3.9%. Saskatchewan, Manitoba, obviously, and no-fault jurisdictions aren't really comparable. Nova Scotia, PEI, New Brunswick, all smaller payments, but you have far less urbanization and you have far less infrastructure, and there's less congestion, et cetera. In Newfoundland, they seem to have some issues, and in Ontario, it's 3.9%. So all in all, the national average is 2.9%, and we're at 3%. So there's things that you can tinker with, but we're not grossly underpaying according to that analysis, depending on how you look at it. What people are doing a bit more is comparative shopping, and it's an interesting trend because if you look a generation ahead of some of us, which gets pretty old now, but they would join with an insurer and stay with that insurer and get their bill from that insurer in the mail and write a check. And now 51% of people sought more quotes on renewal, and out of those, 79 received 2 to 4 quotes. What's really interesting about this is the likely demographic of these people is probably older, and I didn't put that in because I can't prove it, but 70% of the inquiries for quotes were made by phone, which from a marketing perspective, not to tell the insurers how to do things, the feedback there is that they did that, the individuals went by phone because 37% weren't able to get a final quote online. So half an hour in, they still don't know what they're looking at. 29% didn't understand the coverages. That makes sense to me completely. But it's just some nomenclature for your sites, I guess. 16% thought there were too many questions. We get into some funny stuff. 3% thought it took too much time, and 3% must have had bad Wi-Fi because they had slow response time. Another hot topic, if you can call it that, which is, as a board, we talked to the various insurers about it, and we wanted to get feedback from consumers, is the usage-based insurance, which I don't know if I have to explain to everybody in this room. But whether it's an app or whether it's a transponder, in 2017, 57% said they would consider it. In 2018, it went to 54%. And last year, in 2019, it was 48%, which seems odd in our technical world if people think that they can save money. But it's something they don't really want to look into. So other than the purchasing of insurance, who's the most affected parties? The claimants, for the most part. 8% of claimants last year were, 8% of respondents in the survey were in a collision. 75% of those people claimed for medical treatment. 4% of those people were injured, and 42% of those people thought that they had a straightforward experience. So there's varying figures, and I don't want to take up the whole day going through the comparison per year, but it probably goes back to my original comment that you're getting a bit of a different demographic by people who want to say something on this survey. So we get into why are there claims? So hot topic, distracted driving. 55% of people surveyed think that the penalties are reasonable. Out of the other 80% thought they were too light. So there's not a lot of people out there that think that they're too high. Driving under the influence, we've heard a lot about cannabis, seen a lot about cannabis, but it's interesting that most Albertans feel that cannabis penalties should be the same as alcohol penalties for driving. but remarkably 11% of the people who were surveyed thought it was safe to drive under the influence of cannabis. So I thought that was a little interesting. Winter tires are something that's been brought to the board's attention and brought into some of the other discussions. Half the people believe that winter tires should be mandatory, but out of those half the people, 80% of them think that they should get a deduction on their insurance. So it becomes an economic balance that gets really hard to deal with if you're talking about putting winter tires on a Infiniti or if you're talking about putting them on a Mazda. Proof of insurance, I don't even have to go into now because everybody saw the press conference the other day. And I guess what do we do with this information is my conclusion. We obviously share it with the government because that's the mandate we get. We work on sharing it with consumers, but we're not, we get more of issues looking for competition as opposed to issues looking for what people are looking for when people are calling our offices. So one of our goals as we go forward is to develop a better education plan. We're going to work on that. The staff's doing a great job on it so far. And all in all, one thing I put in the conclusion is that 73% of consumers indicated they have a good level of understanding of their auto insurance. So I think some of that might have to be the clicking on the, do you want to take this survey? But overall, I think that's a fantastic number. And that's where I'm at. Thanks.
Thank you, Mr. Cumming. That was exceptional. And on behalf of the board, we just want to thank you for the work you do on behalf of consumers, because it helps provide the board with a balanced perspective when we look at work going forward. Members, any further questions? Chris, any questions? Jay, any questions? Bill, any questions? I have one fast one. What did you find to be the most startling data point as you looked through this? Or what weren't you expecting?
I think there were a couple of startling points, and I made a joke about the one about the cannabis. If we went out and asked 10 people, I can't believe that one of them would say, hey, it doesn't matter to me. I guess I know what that guy does at lunch. But and I really found the last stat that I gave that people, 73% of people think that they have a good sense of what their policies entail and what they're paying for. I think if you went back 10 years on that, that number wouldn't even be close.
Thank you very much for your time today. Because of your brevity, we have time to move forward the Wawanesa Mutual Insurance Company presentation before lunch, so we can compact our agenda a little bit. So I would ask Mr. Hartree and Mr. Persaga to come forward and prepare your presentation, please. Thank you, gentlemen. Whenever you're ready.
Good morning, Madam Vice Chair, board members. My name is Keith Hartree. I'm the Vice President of the Alberta region for Wawanesa Insurance. I'm joined by Jared Persaga, who is Director of our Actuarial Pricing. Thank you for the opportunity to present and speak to you today. We are also, or I'm going to talk a little bit about our company, give you a little background, the importance of the Alberta market to us, and in our opinion, the importance of Wawanesa to the Alberta market. As you see, we're going to also delve into mission a little bit. I'm going to offer some general comments. Jared is going to talk a little bit about our results, and then at the end I'll wrap it up with just a few comments and conclusions. Wawanesa has been around a long time. We actually wrote our first policy before Alberta was in Confederation. We've been doing this for 123 years. We operate with approximately 300 independent brokers and do our best to work with them to make sure that our customers are served the way they deserve to be. We feel that mutual insurance companies are or have been very successful in creating strong relationships with the people in Western Canada. Today, we are the largest mutual insurance company in the country. We are the second largest P&C insurance company in Alberta, and this year we will be have over $1 billion in written premium in the province of Alberta. So Alberta is extremely important to our company, the success of our company, and we have many policyholders that are in fact our owners that live and prosper in Alberta. We have a large operation in Alberta, and this goes to one of the things, or one of the reasons we think that our company is important to the province, the success of our company. We believe very much in having a regional presence. We believe in having most of our business processed in the areas that we do business, and that's why we have over 600 employees in the province of Alberta. We have major offices in both Edmonton and Calgary, and we also have claim service offices throughout the province as well. So we have a major investment in this province, and that's why these rating concerns or the work we do with you and getting to the proper rate is so important to us in Alberta. Our company very much believes, and if I go back to our mission, that it's in our mission that we try and offer our products at the lowest price that supports long-term growth. We don't have stockholders. We're not driven by stockholder profit. We're driven by servicing our customers who are our owners, providing them with sustainable premiums, if at all possible, and making sure that there's a market, that we're in the market for insurance. The inability for us to get the sustainable rates is very concerning to us, and it affects our operations in a negative way, and then ultimately our policyholders in a negative way. I'm going to jump ahead. It doesn't matter from the slide, but I'll just talk about our investment in the province a little bit. I've talked about the size of our operation, but it goes beyond that. Many of you know that our company invested $750 million in purchasing Western Financial a while back. That's also a very major commitment to this province. Their head office is in the province and continues to be. They employ 1,600 people. We've also had some investments in the province that Due to the many claims that we've had in the past few years, Fort McMurray was a $250 million event for us. It goes to, from my perspective, that's what we're in the business for, but it's one of the reasons why you want healthy companies in the province. And we continue to invest in our offices, and as of today, we've got some pretty big investments happening due to weather claims this summer that you won't see on the numbers we're going to present today, but are extremely impactful, or will be. Jared, I'll turn it over to you to...
Thanks, Keith. So a lot of what I had planned to say today has already been mentioned, so I'll be brief in my comments. But we are seeing along the same lines in our bodily injury increasing claims cost along what was presented by IBC and both Oliver Wyman this morning. For us, the increase really can be seen to start around 2011. And of course, in 2012 was when the Sparrowhawk decision was enacted. And it has continued basically since. If we move on to the next slide, for comprehensive is another area where, again, aligning up with that 2011 year, we have seen increasing claims cost quite quickly or quite significantly since that time. Please do remember that we see improvement in 2017 and 2018, the latest 2 points on the chart, but 2016 did contain Fort McMurray, which Keith already spoke to. And we're, of course, optimistic about 2019, but we have had some early events so far in the year which are not included in these numbers. So there is certainly volatility with the changing weather patterns in Alberta that was already addressed this morning. Again, the industry results were discussed already this morning. So consistent with what was presented, in 2018, there was a loss ratio of 85% for the industry and combined ratios well above 100%. Looking at the last 5-year average, 2018 was well in line, the 5-year average being a loss ratio of 86% in the province. And the 2019 Q1 data that we've seen from MSA for a select group of insurers with the market share of over 80% was the loss ratio was 90% so far in Q1. So a lot of the reasons have already been discussed, but the loss ratio for Alberta PPA is a little bit higher than maybe what we would hope.
Okay. I'm briefer than I thought. Some brief comments and maybe, I guess you'd call them asks. When I looked at one of the things I did when we're coming up with our presentation, and this has been mentioned by a couple other people, is look at your mission. And it's actually eerily similar to ours. We want sustainable insurance in Alberta. We want it to be available. We very much want our customers to be looked after and serviced properly. And I'm not sure we're different than the other companies in that way, but we are different from a structure standpoint and come at it a little bit different. And I think we have a very competitive industry in Alberta, and it's healthy to have a competitive and healthy mutual insurers in the province as well. So what I ask is that you live by your mission. I think if you do that, we're going to be happy as well that we can work with you. But when we're not able to get the rate that we need to be rate adequate, what happens is that we have to look for other means to offset that, and that sometimes is not to the benefit of our customers, and that's not how we like to do business. What I would ask is that you consider allowing larger percentage rate increases for companies that can demonstrate they need it, and that's done by coming up with an agreed path to rate adequacy. I'm not suggesting it has to be all in one, but that in order for there to, to have a longer term outlook, there has to be a pathway of getting there, and that's what we'd like to see. We would like to see you consider not having the 10% cap. Certainly understand why it was put in, and I guess my comment to that would be, speaking for our company, we'd certainly be willing to look for ways that will mitigate your concerns outside of having that cap, because we just don't think it serves the purpose that it's intended for. It may be addressing something, but I think there's unintended consequences by having it. Ultimately, we support the work that the IBC has done, that Celeste presented. Although this is not really your mandate, we'd certainly love to see some of the costs taken out of the system, and by that I mean costs that are not negatively impacting the coverage and service that our customers are getting. Just to wrap things up, we are certainly willing to do whatever we can to support the vision of your board and have this product healthy going forward. Open to questions now.
Thank you very much for your time and your presentation. I'd ask members of the board if they have questions. Mr. Daniel, I'll start with you.
Thank you. Keith, I really appreciate your presentation. Thank you very much. And totally agree. I think we're all here for the same reason. We're here for a stable, a robust automobile market, and you've demonstrated that, and I think that's what we're after as well. One thing, and I hate to keep going back to 2004, but 2004 we ended up with some major changes because of the same sort of issue. We were in crisis mode. We're in crisis mode again, as indicated by a number of the industry. So rate is not the only fix. You've alluded to 10%. We've alluded to the 5% cap. We've talked about all of those things, but they are not the real issue. What is the real issue is how do we move forward in a collaborative effort and make sure that the consumer is well protected and has affordable and predictable insurance rates. Other than rate, and you've talked about that, have you any other comments on, and please just briefly, what you might have to offer?
Well, I would like to offer one comment. I've spent the last few days of this week traveling up north through the Lacrete area and that area. And all of the brokers I talked to, and we talked to 5 or 6 of them, all of them commented without solicitation that theft was a problem in their area. And they felt that there was a problem with fraud. That's an instance of a cost that doesn't serve our customers, that no one wants that to happen. That's not necessarily within your ability to control that, but I think there's a lot of things that industry can do, including our companies, the IBC, working with the government. That's something that sort of thing is a cost we can take out without negatively impacting the vast majority of our customers.
follow-up?
Sorry, just to follow up on that one, and I totally agree. I think the previous government and the RCMP has done a really remarkable job in Rural Crime Watch, and they put a lot of money towards that, and I think that's helped. And I think if you look at the figures, they have gone down over the last probably 8 to 10 months. But I think the industry as a whole, and I think IBC has also come into the area of participating in smaller communities. And I see it as the industry as a responsibility to move forward in that area. And if you think, you can work together, especially in the rural areas, to help in that area. Thank you.
Thank you very much. Jamie, any questions? Jay? Bill?
No, fine.
Awesome. Thank you so much for your time, gentlemen, and we appreciate it. All right, it is 11:34. We're going to break for lunch, and understanding that not all of you can truck out of the building and make it back here in the 59 minutes and 59 seconds that would be allotted to you in a normal 1-hour time frame. We will reconvene our meeting promptly and start our agenda at 12:45 with the Alberta Trial Lawyers Association presentation. So please make sure that you're back in the room for 12:45. Thank you. Folks, and thank you for returning to our meeting this afternoon. Just to reiterate, the purpose of today's meeting will be to receive input to assist the AIRB in analyzing industry experience in order to develop industry benchmarks for insurers, and the AIRB to use in the development and review of rate filings. According to legislation, the AIRB must consider industry-wide loss costs, administrative expenses, profitability, and any other matters the AIRB considers appropriate. Today's meeting will not address commercial coverage or complaints against insurance companies or the insurance industry. Presenters and presentations that stray into any matters beyond the mandate of the AIRB's review will be ruled out of order by the chair and will be asked to refocus their presentation. Thank you for joining us again at the annual review open meeting. Our next item on the agenda is the Alberta Trial Lawyers Association presentation. Mr. Lewis, I'll hand it over to you to introduce yourself, and I will wave at you when you get to that 5 minutes.
Thank you, Madam Chair, and thank you for the opportunity to present today before the board. I think it's been a while since the Alberta Civil Trial Lawyers Association has been present. And again, we appreciate the opportunity to have the voice heard of our over 600 members throughout the province. To begin, and I understand that my time did include the ability to ask questions of Ms. Elliott. I did submit 2 questions prior to the meeting here today, and I have had the opportunity to discuss with Ms. Elliott, and I understand Madam Chair has a process to follow. So what I'm going to do is make sure that I read the question that I posed accurately from what I have. Ms. Elliott was just curious what was included in the estimated loss costs for bodily injury severity figures in the Wyman report and AIRB data. Does it include all defense legal, expert, investigator, third-party adjuster expenses, and the like? If so, what is the breakdown of those costs versus what is actually received by the injured party?
So, Ms. Elliott, if you can answer those concisely within a 1 to 2 minute time frame, that would be preferred, so that Mr. Lewis has time to do the rest of his presentation.
Okay, I will answer. The data that we use is the data that's reported by insurers to GISA, the General Insurance Statistical Agency. That data includes the amount paid on an individual case file and the amount set as a reserve on that individual case file. It includes all amounts that are paid associated with that claim. Those total amounts for all claims for a particular accident year are reconciled within the financial statements for the company. So everything that is paid or reserved to be paid is reported to GISA and all aggregated, and we work with aggregated data. In terms of the breakout by category, head of damage or expert report, legal costs, that information, there's no breakout by head of damage that's reported to GISA. The data is a total amount. So we do not know in this aggregated data that we use how much is paid out to the claimant in particular.
Thank you. Appreciate that. And then the second question, I'll shorten it, was simply, is inflation factored into any of the numbers used within the Wyman report?
The costs, when we look at the information, it is by year of accident. So when we're reviewing history, what's paid in 2012, 2013, et cetera, up to 2018, and actually we have 20 years of data, built in is sort of natural inflation, how it goes, changes over time, how costs increase, and they increase for different reasons. So we do not add inflation into these costs of what the ultimate amount will be paid, but when you look at a long period of time, naturally there would be a change over time which would reflect increasing costs due to inflation.
Thank you. Appreciate that information, just in terms of supplementing some of the information from the report. I will attempt as best as possible to get through the presentation and the salient parts of the presentation without unduly taking too much time and leaving some time at the end of the presentation for questions of the board. So in terms of the overview, given that we're going to be discussing it, I don't feel that we need to necessarily hit that. With respect to the Alberta Civil Trial Lawyers Association, we were established in 1986. We represent over 600 members throughout Alberta. The largest percentage of our members represent smaller firms of between 2 to 10 lawyers. It does include insurance defense lawyers, but a large focus of what the Alberta Civil Trial Lawyers Association does is to represent Albertans. And in the context of the proceedings here today, we primarily represent injured Albertans. And we represent those Albertans that have been involved in motor vehicle accidents and that then have to face some of the labyrinth that is out there in dealing with insurance and dealing both with their treatment and then with their claims. A couple of the missions and objectives and our role, and basically touched on, is to deal directly on behalf of the injured parties with the insurance companies. We typically end up in a situation helping individuals when they're frustrated in dealing with the insurance company, having been involved in a motor vehicle accident. Of course, when individuals who haven't been in accidents before are dealing with insurance companies, they're at a disadvantage. They don't know the process. They come talk with plaintiff's counsel to try to work through that process. There's been a lot of talk recently about expansion to the MIR. I think we have to bear in mind what MIR stands for, Minor Injury Regulation. And when we talk about an expansion of MIR, what we're really trying to do is talking about an expansion to the definition which has been interpreted by the courts over the course of the last 15 years. We're in a situation where the Minor Injury Regulation was meant to encapsulate minor injuries. I think we have to bear in mind that when it was brought in back in 2004, it was based on the medical research under the Quebec Task Force, which indicated that soft tissue injuries, generally when treated, would resolve in 80 to 90% of the circumstances. 10 to 20% will go on to have chronic conditions that will impact them for the rest of their lives. Those are the types of definitions that the courts have interpreted over the last 15 years. The courts have been looking at the intent of the Minor Injury Regulation as it was brought in by the government of the day at that time, what was expressed and what was stated that it would cover. Throughout the course of the 15 years, we have cases which have interpreted that. We have medical evidence to indicate that we want to broaden the definition and interpretation of the Minor Injury Regulation. Brings to mind that we're not then dealing with something that medicine and all medical evidence suggests is truly minor. If we're talking about broadening and expanding the scope of the Minor Injury Regulation to that which the medical evidence says has become chronic and will affect people for the rest of their lives, let's indicate that. What is meant by a broadening definition of the Minor Injury Regulation? In terms of pre-cap insurance, prior to 2004, it was a situation where general damages as related to personal injury actions were determined by the courts and based on precedent. Andrews and Grandentoy, decision of 1979, set a cap for pain and suffering damages, general damages, at $100,000. Currently, over $350,000, given that it's indexed to inflation. In 2004, as indicated, there was a move based on an insurance crisis to bring about a cap to what was deemed to be minor injury regulations. Prior to that, there were decisions which indicated general damages for soft tissue injuries which resolved in a short period of time would garner between $1,000 to $1,500 general damages for each month. The minor injury regulation, when looking at the medical evidence and the data indicating that 80% of soft tissue injuries would resolve with treatment within that span of time, 3 to 6 months, encapsulated what the understanding was at that point of what general damages should be for minor injuries. We can talk a little bit about the history of what happened in 2004, and that's what the rest of these indicate. But in essence, it was the insurance companies indicating that there was a crisis with respect to premiums, which required government intervention. So the government of the day, notwithstanding that it's a free enterprise economy, stepped in, provided regulations with respect to general damages for minor injuries, what were deemed to be whiplash-associated disorders 2 with non-neurological compromise. In terms of the financial information, this I think is available to all of you in terms of the general financial availability. This is open information, but that's insurance company profits over the course of the years. What's interesting is back before it was brought in, while there was discussion, yes, there was decreased profits, but what we saw when it was brought in 2004 is that it had resumed in terms of profitability. By that point in time, the reforms in 2004 were already on track and it moved ahead. Again, more of the history. The current adjusted for inflation minor injury cap is $5,202. Again, as indicated in the Wyman reports and all of those matters, inflation isn't factored in, but inflation is factored in when we're dealing with the minor injury regulation and the amount which is paid based on the $4,000 per year at the 2004 year. This is what was indicated by the government of the day that the minor injury regulation would capture. It was introduced to Albertans, and Minister Nelson at the time indicated, we've always said the cap will only apply to minor injuries that heal relatively quickly. About 90% of people with minor injuries will recover from their injuries within 12 weeks. The other 10% may require further treatment which will be available to them, or their injuries may not be minor, in which case the cap would not affect them. Again, minor injuries. Those medical evidence suggests is going to resolve within that period of time. The regulations surrounding the interpretation, at the outset, there was a lot of uncertainty about what the cap applied to, what it didn't apply to. What did that lead to? Court decisions. And who bears the cost of that at the end of the day when you have to go to court to have things resolved? Ultimately, it's insurance companies, and that is something which is calculated within this severity number that is being used. We don't know what amount is going actually to the plaintiffs, to the injured plaintiffs. There's no breakdown of that type of information. We don't know how much of it is going to insurance defense, how much is going to defense medicals, and how much is being paid to fight those types of definitions. So over the course of time, there were a number of decisions. I'm going to go through them because I think everybody kind of knows what happened. We had the cap, Queen's Bench decision, which was overturned by the Court of Appeal, and then we had some decisions which said, okay, this is the cap, but what does the cap apply to? What is it really intended to apply to based on the medical evidence, based on the injuries, and based on the intention of the legislation. And again, if we're saying the intention of the legislation is truly to capture minor injuries, it captures minor injuries. And that's what the courts have indicated through the numerous cases that have gone through, from Sparrowhawk, which indicated that TMJ was not something which was encapsulated within the intention of the legislation to be a minor injury. And of course, we know that recent changes which have been made to the legislation have indicated that certain TMJ will be considered minor injuries. McLean and Parmar. I know this is used, and actually it's referenced in the Wyman report, as indicating that all injuries over 3 to 6 months are going to be considered non-minor. That's not the case. That's not what the judge said. The judge said that Ms. Parmar suffered from chronic pain. There were certain aspects which weren't going to resolve, that for 2.5 years she experienced a situation which fell outside of the definition of minor injuries. That's one of those 10% to 20% of injuries that don't resolve within that short period of time. Again, if this is a situation where it's felt that the judge misinterpreted the legislation, the Court of Appeal is there. The insurance companies have the ability to go to the Court of Appeal with this case, chose not to. Of interest in this one as well is that all of the medical evidence that was presented by the defendant in that case was a documentary review. There was no independent medical that was done by the defense in that situation. Jones and Stepanko, again, clarifying what is truly minor. And there's comment in there in terms of the certified medical examiner that in 15 years had never assessed anybody as having a serious impairment. Again, these are all public decisions. I encourage them to be read, and I'm sure some of you have read them. Changes, as we discussed in terms of some of the further amendments, that was something that occurred without much in the way of discussion. I know the Civil Trial Lawyers Association was not involved in any discussions before those changes took place. However, they went through. What we do oppose, though, is an expansion to what is considered the minor injury regulation. I feel like a bit of a fish in a shark tank here, so but I think it's fair to understand that all of the information which is received, that Wyman bases it on, is received from the Insurance Bureau of Canada through GIZA. What's interesting to note is at the bottom of, I think it's page 10 of the Wyman report, it indicates that GIZA itself says that the statistics shouldn't be relied upon because of failure to report by certain of the insurance companies. We don't know necessarily what the true wording of the caution is, but it is something that's there. We know that none of the information is verified, audited, or even parsed through, but accepted. And when we look at the Wyman report in terms of the cautions, one is that we're saying that the information received is accurate. Well, the Insurance Bureau of Canada has indicated that information shouldn't be relied upon and isn't necessarily accurate. That's a bit of an overview, I guess, in terms of some of the concerns that we have with some of the information that potentially comes out. What we do understand is that it's a situation where everything is included within the severity, but it's something which we don't know what is necessarily broken down there. So I think we all know who the Insurance Bureau of Canada is, so I don't have to necessarily get into that. It's interesting in terms of some of the comments that were made by past presidents in terms of the time to bring about change. And what we have heard consistently is crisis, crisis, crisis. And I think some of the information that we'll get to in terms of the Wyman report doesn't necessarily indicate that bodily injury claims over the course of the last 4 years have increased significantly. And I think that's the information that came out today. In terms of broadening the cap, that seems to be some of the main focus. ACLA can agree with a lot of the information that is out there, and we can agree on certain things that need to change. We do have a changing dynamic right now in terms of what's happening in the industry and with vehicles, going from safer vehicles, more autonomous vehicles. In terms of the intention, I appreciate we can agree to disagree on some of this, but in terms of financial and the profitability, that's something that we want to have a healthy insurance industry in Alberta. Everybody wants to see that. It's how do we go about doing that? And do we do it on the backs of injured Albertans? That's really the question that it comes down to. The sky is falling arguments. I mean, we've heard that today, and I'm certain that we'll hear some of that here this afternoon. This really comes down to a little bit more in terms of the information and the fact that the base information isn't made available. We're accepting the information which is received by Giza, presented to Wyman, and with no ability to go and scrutinize. And that's been commented on several times in the past in terms of reliance upon that information. Premium increases with claims payouts. If we look at basic rates alone, they've only increased 2.5%. So when we look at the insurance and when you look at the two different types of insurance, when we're dealing with bodily injury claims, we're dealing with basic insurance rates. That gives a little bit of a historical, not taking into account the variabilities from year to year. But while we've got basic auto insurance increasing 2.5%, additional auto insurance premiums increased 42.16%, and the average vehicle cost increased 36.5%. So claims cost increases, and this is, I guess, where I want to understand some of the information, because it appears to me, based on the information, that in 2015 we had a spike, an increase, based on whatever factors those might be. I don't know whether it's reserves or whether it's the actual payouts. What I did hear today, I think, was a situation where the actual payouts represent about 10% of the severity amount, where, and I could be corrected, but I think that was my recollection, whereas significantly more than that is based on reserves. So if we're basing it on reserves, that's certainly what the insurance companies expect to pay out over the period of time. Again, kind of mentioning in terms of the caution that's to be had with respect to some of the errors by individual insurers. This is based on the last annual AIRB report, and it shows that flattening, which is occurring in 2015, 2016, 2017, 2018. We have 4 years of essentially flat severity when it comes to bodily injury claims. And at the same point in time, we have decreasing, up until the last year, numbers and incidents. In terms of a crisis, and a crisis which is related to bodily injury, and when we look at what are we going to look at as being the incidents for down the road, or how can we expect what it's going to be? Over the course of the last 4 years, it's essentially flat, and it's decreased in certain years. So I was only able to pull some of the information here more recently on insurance companies, and I appreciate that this is AMA and this is publicly available and it's on the Alberta Finance site. But when we have a situation where we have an insurance company in crisis, the Q1 net income was $8 million for 2019 and $15,592,000 in 2018. So depending on which statistics we're using, and if we're using 2017 as a yardstick, what is the more recent data and what does it suggest in terms of profitability. The insurance companies have had 3 or 4 years to deal with these bodily injury claims, and what have plateaued and actually decreased. I don't know whether AMA is simply an anomaly and they're much better in terms of having cleaned things up. I'll leave that to the companies themselves. We want a competitive marketplace. Currently in Alberta, there's 69 insurance companies which provide auto insurance. I believe that number is still accurate today. And the consumer representative indicated that, yeah, they're shopping around, they're looking for lower premiums. In terms of deregulation, looking to deregulate in certain aspects, but let's regulate in another aspect and bring in some changes to the definition of the minor injury regulation. It seems a little incongruous in terms of how that would work. If there are changes made to the minor injury regulation, they will not necessarily be reversed. That is something that if government is looking at doing that, and I appreciate this is not the venue for that, but if government is looking to do that on the basis of information which indicates that it's stabilized, that's not going to be reversed. That's something that should be done with caution and should be reviewed. We have changes which have been made to the regulation, and the insurance companies are indicating, well, it's going to make no change to what it is that we have to pay out. If that's the case, why are we looking to make changes to the minor injury regulation? As indicated, we want to see a situation where we work together to make sure that we have a robust and healthy insurance market. There's a number of changes that can be brought in to do that. We do have safer vehicles now. We see the incidents decreasing. We want to see a situation on Civil Trial Lawyers Association where those who are responsible for accidents pay higher in premiums. I think my friends at the Insurance Bureau of Canada and myself can agree on certain things that we want to see to try to reduce and make for a healthier insurance companies. And some of that might be a review of the grid rate system. Now, I agree that new Canadians and younger drivers, until they show that they're bad drivers, let's use a grid rate system for that. That's fine. But if somebody goes out and gets a DUI, if somebody's convicted of careless driving, if somebody causes an accident because of undue disregard for other users of the road, should good drivers be subsidizing that? That, I think, is definitely a discussion that needs to be had, because I don't think that's necessarily the intention of what any government would necessarily want to see. So in terms of suggestions at this point in time, let's take the time to see what happens with these rates that have stabilized over the last 4 years. Let's take some time to see what happens with the new minor injury definitions that have been expanded. And in terms of maintaining the system, we've gone through 15 years of interpretation by the court to determine what the minor injury regulation actually applies to. Again, decisions based on science. I know that I wanted to leave a little bit of time for questions, so I'm certainly open to those.
Thank you, and I hope you all had your caffeine because you have about 3 minutes to ask those questions. Bill, any questions?
No.
Jay?
More of a comment.
If you can make it quickly,
Yeah.
that'd be great.
So anyway, I appreciate you coming to speak to us. You know, as a regulator, I think it's important for us to hear every stakeholder's opinion. So I'm glad to hear the trial lawyer's perspective on the current auto marketplace. And it's a bit of a different perspective than some of the other presentations we're seeing today. So that's my comment.
Thank you. Jamie? Chris, did you have one?
Yes, thank you. On slide 37, if we can, you don't need to necessarily go back to it. you're showing that the, I think you made comment that the frequency had dropped and the quantum had remained stable. So if you look at slide 37, we see that the frequency has dropped since 2002 quite dramatically. Although it went up to in 13 and then slowly came down, and then the last couple of years it's dropped. What do you account for the, first of all, for the increase in quantum when you're looking at a decrease in frequency? Do you have any insights into that at all?
And Mr. Lewis, you have less than a minute to answer that question, please.
Sorry about that.
And I'm sorry, some of it is a little bit confusing. What I did take from one of the presentations today was that there was a significant increase in comprehensive claims from 2011. I don't know necessarily if we're talking about a correlation between some of the decisions. I don't think that's necessarily the case, because decisions wouldn't affect comprehensive claims. In terms of severity and the actual number, my understanding is that we have a situation where severity is plateaued and the incidence of the accidents has actually decreased, but I may be misunderstanding the question.
Well, in order to clarify that, I'll ask Mr. Daniel to send you an email so that we can get feedback on that. Lori, you had a point of clarification, and I'd just like to say thank you very much for your time. And we'd ask Aviva to get ready to make their presentation. Lori, you want to make that clarification?
For sure. I just wanted to clarify, you had made a comment about Giza service provider being the Insurance Bureau of Canada. I just want to clarify for you that that is a distinct division, and it is not, it's separate and distinct from the Industry Trade Association, and the Industry Trade Association has no involvement in the development of those statistics, just to make sure that's clear.
Thank you very much. Thank you again for your time. And we would invite Aviva and their representatives to come up and present, please. Thank you very much. I'll hand it over to you to introduce yourselves, and welcome.
Good afternoon. I'm Mark Rouleau. I'm currently the Senior Vice President for Aviva in Western Canada. I'm joined today by Fanny Paz-Prasad, Vice President Personal Lines, and Joanne Dislodges, Vice President Casualty Claims. We have a lot of material to go through. You've already have seen most of it, so we're going to move quite quickly. I now have control of the clicker, so that's a good sign. I'm just going to go through it. I think the opening for us is that this is a problem. We've had a cap in place that's compounded our problem. There's no scenario where there's the industry's making money in Alberta, notwithstanding some of the other allegations of wild profits being made. It's just not the case. Our forecast on even simplest forecast on costs has losses in the 2014 to 2018 period of over $2 billion. Sadly, Aviva's story is worse than the average. Sorry, I'll just jump back to that because I want to point out something to you. The combined operating ratio, or CORE, has been running north of 100 for the period 2014 to 2018. And just for level setting, anything north of 100 is an underwriting loss. Aviva's story is even more dramatic in that our losses have been in the 120 circa and as high as 129. And you can see the trend, which is in fact audited and reported through all our various financial institutions across the country. So the story, is it a crisis? It's a problem. And as it stands right now, the costs of the product that we have in place and the costs and the draw against those products are not covered by the premiums. It's compounded by the cap that's in place and doesn't allow a carrier to get to rate adequacy. So it's a bigger problem than again, I'm trying not to use the word crisis, but it's feeling close to that. I'm going to turn it over now to Fanny, and she'll take you through some of our data.
Thank you. I'm not going to bore you with things we have already talked about this morning, but I just wanted to share with you the slide, which basically shows, the rate that we have gotten in the blue bars, and then what we actually asked for in the orange bars. So when the orange bar is above the blue bar, it means that we didn't get quite what we needed from a rate adequacy point of view. And you can see that the orange bars have increased substantially in the last couple of years. We have rate residuals between 10 to 30 points, depending on the company. And it's not sustainable for us. But, we continue being a player and a competitor in the Alberta market, and that's what we want to continue doing. However, with a rate inadequacies of between 10 to 30 points, it's just not sustainable. In terms of loss trends, I think we can safely say that this have been shown a few times this morning. And the only thing that I'd like to add is that Aviva's own trends, based on our own data, are very similar to these. We have a higher future trends for BI accident benefits, where future trend is around 11%, not 8%. And for accident benefits, it's also around 11%. We do have lower future trends for collision and comprehensive, to give or take a point here and there. So in general, we generally agree with the retro trends, but they're slightly higher on a prospective basis. And I'll turn it to Joanna.
Okay, so I'm going to address the BI claims cost question that's been plaguing us for some time. This is a story you've heard this morning, and you'll continue to hear, certainly from Aviva. And it'll come as no surprise that our BI claims costs are on the rise and have been for quite a significant time. They've increased, our BI loss costs have increased by 90% since 2011. And it's really mainly due to severity. The severity increase has been 200% since 2011. That is significant. And we will go further into that story and give you more of an insight into why that's happening. But to really highlight, it's less claims that are settling within that minor injury cap that are lasting longer than 6 months. We're seeing a significant increase in site claims and concussion claims over the last 7 years. The duration of injuries are longer. And we're seeing the same trend in A&B. In accident benefits, they're using the A&B file to drive the BI claims file. So over the next few slides, I'm going to take you through why we've come to those conclusions, the supporting data, including the close claims study that we've recently completed. But before I do that, I do want to take a bit of a tangent, because over the past couple of years, certainly some of the concerns and allegations are that reserves are part of the drivers. This is a very busy slide, and I don't want to spend too much time on it. But what I do want to would like you to focus on is 2012 and 2013. You don't see very much discrepancy between the red and the green, right? Telling us that what we've predicted we're going to pay out in claims costs is actually what we paid out. Volatility, however, has started to set in, starting in around 2014 and 15, where you start to see some real significant differences, and we're putting up now more. What we expected to pay out is far less than what we actually did pay out. So our reserves, in fact, according to this, we could be under-reserved. And that's certainly some of the conversations our team has had with our actuarial team. Right, so what's driving all of this volatility? One is the minor cap, is erosion in the minor cap. So When this was first introduced back in 2004, Aviva had a fairly steady approach and a consistent approach to managing those claims. And that hasn't changed. The way we've approached these claims hasn't changed. What did change is the McLean decision. Even Sparrowhawk wasn't that significant for us. It impacted a very small number of our claims. Where the change happened is 2015, and that's showing up in our data, where we saw a drop from 82% of our claims settling within the minor injury cap down to 67%. And what's happened? Claims costs go up, severity has gone up, right? So you look at that trend, decrease in the minor injury settlements, increase in the average paid. Pretty hard to argue with that. And for us, every single claim that does not settle, any percentage point that doesn't deterioration in minor injury settlements is about $900,000 in indemnity payout for us. Right? So I really, despite what some of the concerns are from the Trial Lawyers Association, for us the McLean decision was a turning point. So how do we actually look at this? So the distribution of the compensation to claimants and why general damages and pain and suffering are so important to us is because they represent 54% of the compensation paid out to claimants. Right? So any change or anything we can do to help mitigate that will have an impact on the costs and hence premiums. Right? One thing also to remember, and something that I think we lose sight of, is that this applies to only about 1% of our drivers that really draw in a BI claim. So we have 99% of our customers who now have to suffer and pay higher premiums because of that 1%. Appreciate that's not fair, but the demand for premium is what we need to do in order to just even stay profitable. I want to give you a bit of insight into what we learned through the closed claims study. And we've divided into 3 buckets. So 2010, 2012, and 2017. And what you see is a real dramatic shift between 2012 and 2017. 2010 and 2012 are fairly consistent, a few deviations here and there, but it's that jump from 2012 to 2015 that really spoke to us. In 2012, 68% of the injuries were sprains, strains, and WODs that fell within that minor injury cap. In 2017, it dropped to 42%. And what we saw was an increase in the sprains and strains that lasted longer than 6 months. They went from 2%, 3% the year before 2012, to 24%. What we also saw was an increase in site claims, because we know site claims aren't covered by their minor injury cap, and they jumped by 150%. And concussion injuries have increased by 500%. Right? Psych injuries went from 6% to 15%. Now, I know we had, and there's some clarification provided around the amendments to the minor injury and the inclusion of site claims when they're derivative of the sprains and strains. So we looked at that as well. This still hasn't played out yet in our numbers. It's still early, but our predictions are this will have a very minor impact. Right? Using the data from the closed claims study, it was our assessment that about an additional 5% of the sprains and strains would qualify for the minor injury, and about an additional 4% for TMJ injuries. So overall, this only represents about 4%. So really small impact, right? Because the injuries are lasting longer than 6 months. We're seeing the same trend on accident benefits. The AB med costs have been going up, and loss costs have gone up by 189%. Why? Driven mainly by severity. And again, we're seeing less claims closing within the protocol. More treatment is being provided. And we're also seeing the AB claim being built up to feed the BI claim. They're very closely connected. Now, we appreciate that this only represents $80, that total premium, so it's a real small percentage of our total premium, but the impact, because of the downstream correlation to the BI claim, is quite significant. So when we look at the increased med rehab severity, the percentage of claims that settle within the protocol or outside of the protocol have tripled since 2011. And these claims are now accessing a bigger portion of the $50,000 limit. We're seeing more legal representation on the AB claim, yet there are no disputes, leading us to believe that the AB claim is now being used to fund the tort. This one is an interesting slide, because while our med rehab costs are increasing quite significantly, and that trend is quite steep, and we're seeing a similar trend on disability benefits, but it's nowhere near as steep as the med rehab, suggesting that there potentially is some overtreatment taking place. So, all this to say, this is not new. This has been a story we've been telling for the past 2 to 3 years. Injuries are becoming more expensive. What's interesting is catastrophic injuries are decreasing, and they're on the decline. Why? We're seeing safer cars, safety features in the cars, and our road safety programs and campaigns are having an impact. So yeah, we're seeing a decrease in catastrophic injuries, but unfortunately, our claims costs continue to be, injury claims continue to be more expensive, right? BI severity and med severity are increasing. We're seeing a higher percentage of psychological claims, higher legal representation in accident benefits, though no disputes, erosion of the minor injury guidelines. We do not see this trend changing unless we see major product reform. BI claims costs are going to continue to increase. And it's unfortunate that this is on the back of 99% of those customers who don't attract a BI claim.
Hi, I'm going to briefly touch on the physical damage costs. I think you've already heard some evidence earlier this morning on that, and our experience is the same. Our collision loss costs, while the frequency might be going down, our actual costs are going up and have gone up from the period of 2016 to 2018 by 30%. What's interesting about the reason is that while we had all anticipated the vehicles becoming more safe through collision avoidance systems that are available today, we have found that that hasn't necessarily led to lower costs. The accidents are still taking place, and what we're seeing is a high number of costs associated with the number of parts in each repair and the average costs on the parts that are being replaced. And I think you can imagine that these current sensors that are used to help steer vehicles around or to help apply brakes early, when they do get damaged, they are very expensive. And I can attest to that. My own car had an unfortunate incident. A rock chip hit one of the sensors, which you wouldn't think would be a big deal. It was a $1,200 big deal. So it kind of gives you a sense of the magnitude of a single sensor on the front of a bumper of a very typical car. Also earlier, you did hear a little bit about theft claims, and it's also our observation that theft claims have climbed. We wonder the impact of the economy on the number of theft claims, but it has been growing extensively, and our frequency has jumped 64% from the period of 2014. I think it ties similar to when the economy started to turn down. We also, again, not unlike this morning, you did hear a little bit about fraud. It's our sense that there is an element of fraud in our claims, and Aviva takes that very seriously. We have pursued repair facilities, healthcare facilities, where there's apparent fraud, and we pursue it wherever we can. It's our sense that in the Alberta marketplace that in 2017 we had 765 believed incidents of fraud. I'll just point out that in that, where there was actual fraud involving the claim itself, 38% of those claims were theft-related, and where there was a policy-related fraud, 24% were theft. So there is something going on in the theft story, and I think we heard from our friends at Wawanesa that it's something that consumers are concerned with. We're concerned with it. It is driving up costs of insurance. I'll turn it over to my friend Fanny for a comment on the grid.
Okay. So again, we heard about the grid, and I think incredibly enough, we got consensus across everybody. We talked about it, but just, you know, to make sure that you hear my voice as well, is that we basically have a system where good drivers insure new drivers or insure drivers with who otherwise would go higher than what the grid allows for. We have approximately 5.5% to 6% of our insureds are on grid rates. It continues being the same, even when the grid premiums go up, the same percentage of insureds stay within the grid, which tells me that they were like far above what they should have been charged. It's not functioning as it was intended in 2004. It's protecting the poor drivers at the expense of all drivers. And, you know, this degree of cross-subsidization is just not, I think to echo the words from IBC this morning, what was the public purpose goal for implementing the grid, and are we meeting that goal today? So, in conclusion, going back to the slides that we had before, we have that the 5% cap really hurt our company. We have a rate inadequacy of between 10 to 30 points across our companies. We have not been allowed to keep up with our increasing costs. We heard from Joanna about what's driving those costs. We heard from the IPC this morning about BI being the main problem, and that's exactly what Joanna showed you. We expect that the injury coverages will continue increasing at a higher rate than what Oliver Wyman and Ron Miller, whereas for us, comprehensive and collision are a little lower. The June 1st, 2018 minor injury definition will have a very limited impact. The accident benefit loss cost trends are especially high for medical, and it appears that the accident benefits claim is being used to build up on the bodily injury claim. And finally, the grid, it's really not performing its purpose from our point of view. Thank you.
Thank you very much for your presentation. I'll ask members of the board if they have any questions. And I'll start with Jay, just to shake things up. Jamie? Chris? Bill? I just had one question as an oddity. You mentioned a massive increase when it came to concussion injuries, and I wondered if you believed that was as a result of better science around the diagnosis with concussions, or in identifying them, or if there was something else there that you thought was at play.
So that is definitely one of the real possibilities. Certainly concussions have been in the media of late far more frequently, especially when you have high profile sports players who are now coming forward with concussion injuries. The challenge with concussion is that they are still subjective, right? It is based on self-reported complaints. A lot of these claims were not serious concussions, where future impairments were not ongoing. right? So on some of these, where we're not paying for future care or we're not paying for future income loss, we would consider those minor, and people have gone back to their daily lives. But because it's a concussion, it doesn't fall within that minor injury protocol. So absolutely, you know, the media and the press around concussions are making this more front and center, but it's that impairment on that individual that we really need to look at as opposed to that diagnosis. Some concussions, you can recover within a month, and others it takes a lot longer. And that's what we need to look at, is the impact on that individual as opposed to just the term concussion.
Thank you very much for the clarification. If we have no further questions, I thank you very much for your time and for being here this afternoon. And with that, we will move on to the presentation from the cooperators group, please. Welcome, and whenever you're ready, I'll let you introduce yourself and move on with your presentation.
Thank you. My name is Lisa Giglietti. I'm the Chief Operating Officer of the Cooperators, and I have with me George Harvey, who's our Vice President of Home and Auto. It's a pleasure to be here to participate in the AIRB process. Before we start, I just want to take the opportunity to recognize that we're all working in a very difficult environment now. Insurance, all insurers, as well as the AIRB. And just to recognize that it will require the work of all of us to really help ensure that we have availability and a robust product, to use your own words from this morning. I'd also like to commend the AIRB on the recent changes to the simplified filing process, which is a very significant change. So, in the interest of time, I'm going to move quickly through this. I'm going to start and do a brief background on the cooperators, then I'll pass it over to George to speak to some of the specific items we wanted to highlight. So, just to start with the cooperators, we're a leading multi-line insurer in Canada. We're a financial services cooperative with under $42 billion of assets under administration. We provide solutions to our clients in the areas of property and casualty, life insurance, institutional investments, as well as brokerage services. We're a cooperative. It is in our name, but I want to highlight that. What that means is that we are democratically controlled. So we have 45 member organizations, and we have a board of directors that is elected from those member organizations, and our profit goes back into our communities through those organizations as well as through their members. A note that I will make is that we're not a member of IBC, although we do take the opportunity to collaborate on areas of mutual interest, such as fraud prevention. So in terms of our footprint in Alberta, we have a very large footprint in Alberta, which we're very proud of. We have over 700 corporate employees, and in addition to that, we have 127 independent advisors who employ over 600 staff within their local communities on top of the 700 corporate staff. We write about 226,000 private passenger vehicles, and it's important that we give back to the community. And I will mention, of our 45 member organizations, 9 of them are Alberta-based, and there's a few on there to give you a sense of who they are. Our approach to auto insurance has 4 fundamental principles driving them. Some of these have been mentioned before. I think they align quite nicely. Security, affordability, availability, and simplicity. So for the sake of time, I won't read through those, but again, I think that they are key in terms of how we think through our decision making, as well as any product changes that we would propose in terms of dealing with some of the challenges we have. So to provide some context, here's our financial position for 2018. So as an organization on a consolidated basis, we lost $37 million, including underwriting as well as our investment gains. The vast majority of that is driven by our underwriting loss. So we had $152 million of underwriting loss, a significant portion of that being driven by Alberta Auto, and we'll get into that in a few slides. Our combined ratio was over 100%, which of course drives the underwriting loss. And when you couple that with the decrease in investment opportunities and gains, that led to our overall financial position. So as an organization, we have a target of 12% ROE. Our target is really a reasonable target that allows us to remain profitable. We look at it in terms of our sustainability to remain in the communities that we're serving and to continue to invest in our business and again in the communities and in our members and in their organizations. In terms of the 12%, what does it mean to the consumer? It translates into a 5.1% profit margin on premium. And the thing that we wanted to highlight here is that, and I think this has been mentioned earlier today, is the challenge that we're seeing as well as the industry in terms of the amount of dollars that are going out to claims payment. So for every dollar that we are collecting, we are paying out 83.9% in claims costs. When you put your expense ratios on top of that, of course, that's where you end up with combined ratios well above the 100%. In terms of our specific, those numbers that I presented earlier were national, all lines combined. This is our specific Alberta auto ROE because that's what we're here to talk about today. And as you can see, there was a time very early on where we were achieving our target ROE. And again, our target ROE is meant to be a long-term target. But you can see the challenges that we've particularly had since 2015 in terms of achieving a reasonable rate of return. So even though over the 5-year period, this translates into about a 3% ROE, you can see there's a significant difference depending on the year, and certainly a significant difference when you look at the more recent years. So with that, I will pass it to George.
Thank you. So now, I guess I'm in charge of this here. So I'll just move over to some loss development and loss costs trends. First, some of the items you'll hear here are consistent with some of the communication you've heard from other folks presenting to you with regards to bodily injury. And our internal experience shows continued prior years adverse loss development and a worsening trend. And our own experience of loss development is similar to what you heard from Oliver Wyman's findings. And on here, we'll note that in 2017, in accident year 2017, our losses developed 20% higher when compared to the average of the prior 5 accident years, including 2016. And the corresponding number for 2016 accident year was 13%. So 13% to 20% indicates a worsening trend. Regarding our overall loss cost estimates, our findings are a little bit different than what you heard from Oliver Wyman today. Our internal data shows continued overall deterioration. In the 4-year period from 2014 to 2017, our estimate of ultimate loss costs increased in 2018, and we observed a pattern of higher than expected development. We find it's an ongoing challenge to accurately reserve losses, particularly when a claimant is represented, because it often takes 2 years after the accident to receive initial information about a plaintiff's loss. And as a result, it's common for reserves to be impacted 2 to 3 years post the accident, resulting from previously undisclosed information or negative contingencies. For our accident benefit claims, we initially experienced significant adverse loss development in 2016, but since that time, it's been difficult to gauge whether there's any deterioration given that there has been some volatility in the results observed. So some comments on our bodily injury claim severity. Similar to the industry results presented by Oliver Wyman this morning, we continue to see an increase in bodily injury severity. And we believe this impact on severity is occurring because court cases impacting the injuries that were previously accepted as under the cap are driving up settlement amounts. And here we would reference the 2015 McLean and Parma decision, which served to push minor injuries outside the cap. And therefore, files are remaining open for longer periods of time. We do want to note that clarifying changes to the minor injury definition have certainly been an important step. But that has not resolved the issue, and they're not in sufficient magnitude to offset the trends. But we do believe that they were important. So other factors impacting severity and loss costs include increasing legal representation on all files and not just complex files. And there's an escalating trend of costly expert reports commissioned by third-party solicitors. And while this is something we might expect on serious or complex claims, we're seeing this more and more on mid-value claims. So these reports and responses can total 20 to 30% of the total settlement value. And we expect this trend to continue over the long term. So loss trends on thefts. Our vehicle theft claims peaked in 2017 and were followed by an 8% decline in 2018, so that's positive. However, our 2018 theft claims remain well above the 2015 and 2016 levels. And I think we've seen that in some other presentations earlier. And so while we see the 2018 decline as positive news, it's too early to know if this is a new trend or just a blip in the trend line. What we know for sure is that many of the vehicle thefts are preventable. For example, vehicles left running to warm up during the winter are easy targets. And that lines up fairly well with something earlier this morning around temperatures being cold, -5, and more vehicle thefts. Therefore, we do support the work in the province to reduce vehicle thefts, and some examples of that's things that we support and where we do provide support. So we support the work of the Calgary and Edmonton Police Force teams focused on auto theft prevention, and I know there are task force teams working on that. We also support the RCMP BAIT vehicle program, and we donate vehicles to this program to combat auto theft. And we encourage continued public education measures on theft prevention. We also recommend that the comprehensive deductible should apply to claims for theft of the entire vehicle to give drivers more financial incentive to prevent their vehicles from being stolen. And in the current wording, the deductible for theft of the entire vehicle is waived. The minor injury regulation amendment, as I noted earlier, we applaud the positive steps taken to control the escalating costs, and it's now been a year since the amendment to the minor injury regulation came into effect. While the amendment does provide greater clarity, it hasn't had yet a significant impact on our bodily injury costs. And due to the time factors associated with these kinds of claims, it might be years before we can accurately measure that impact. But we continue to believe that the changes haven't gone far enough to ensure the true minor injuries remain within the cap. For example, many soft tissue injury cases are pushed outside the cap by the 3 to 6 month resolution window, which limits the impact of the minor injury regulation amendment. And we do hope to see further consideration on how the regulation can adequately address claims trends. Some comments on the rate cap. So the insurance market has been significantly impacted by successive ministerially ordered rate caps and the AIRB's own rate cap. This means that we've been unable to charge rates commensurate with risk and with cost, and that negatively impacts our underwriting results. And as noted earlier, in 2018 alone and over the last 5 years, we incurred substantial underwriting losses in Alberta Auto. So while we recognize the intent of the rate caps are to provide more stability in household budgets, they only serve to mask an underlying problem. And in addition, it's clear from our experience over the last few years, they also negatively affect consumer accessibility and choice, market sustainability, distribution viability, and insurer solvency. We should also note that insurers continuously seek to improve rate segmentation, which means that price stability at the client level cannot be achieved through rate suppression. Therefore, we believe rate suppression is not a viable long-term solution. Now, some comments on alternatives to the rate caps. In our view, addressing claims costs through product reform will be more impactful in stabilizing the price that Albertans pay for their auto insurance. So we'd like to continue to advocate for measures including clarity around the minor injury regulations, moving to a direct compensation model for physical damage, updates to the rating variables, and improving clarity for restricted variables, focusing on those that are truly discriminatory, increase the number of rating territories, and implementing a file and use approach. We are also an active advocate for road safety, and we're a founding member of the Canadian Coalition for Distracted Driving, where we're working to reduce instances and increase penalties for distracted driving. And improving the safety of our roads and working to reduce distracted driving will help to prevent accidents and claims, which in turn will help to address rates. We'd also like to commend the City of Edmonton for its Vision Zero strategy, which has been in place for some time now and which has reduced serious injuries from motor vehicle collisions. Implementing similar plans across the province could help to improve road safety for drivers, pedestrians, and cyclists. We'd like to comment on some recommendations. We're pleased to have the opportunity to present our thoughts before the board today, and we trust that the information will help the AIRB with their industry benchmarks. We understand as well that you can't fix all the issues that we've highlighted, but we do feel it's important you have a full understanding of the challenges that we're facing. And a return to adequate profit is critical for the sustainability of the auto insurance market. In the short term, we recommend that the government allow the ministerial order to expire without any new replacement. And given that we believe the AIRB's cap is not meeting its original objectives, we also recommend a return to allowing insurers to make rate-level decisions that support their sustainability. This is necessary in order to manage our existing book, but it's critical to managing dislocation and new business. The continued rise in bodily injury severity is a major loss trend that needs to be addressed. And the intent of the minor injury cap is a positive step, but we do hope to see some further action to ensure that true minor injuries remain within the cap. We believe that long-term, just allowing rates to increase forever is not really the long-term solution, and what really matters is product reform. We believe will have a greater long-term impact on the insurance market than rate suppression measures. So the reforms that we've touched upon today will result in meaningful reduction to claims costs, which will drive the price that Albertans pay for their insurance. These reforms should aim not only to reduce claims costs and the cost of insurance, but to improve the experience for consumers, ensuring a strong, competitive, and sustainable marketplace. We are committed to working with the board and the government to develop these important reforms. And we recommend that the board incorporate the findings from the ongoing claims and cost study, which is, I believe, near completion, to help inform with the industry benchmarks. And we are pleased to be a participant in the claims and cost study as well, and have provided a great deal of information that the AIRB can draw from. Thank you for the opportunity to discuss our loss development, loss trends, and our recommendations.
Ms. Guglietti and Mr. Hardy, thank you for being here this afternoon. Questions from the board? Chris, any questions?
Yes, thank you. In your recommendations, you didn't talk about the grid. We did hear about it this morning. Do you have a very brief comment on that at all, or would you prefer to pass?
Yeah, forget how that works. We do like what we heard this morning. We have challenges and experience with the grid, particularly given its complexity. And we do find that, I would say generally as our own philosophy, we really don't support subsidization of poor driving behavior, because ultimately we believe that that doesn't result in the change in behavior that people need, that they are motivated to achieve through the rate that they should actually be paying. So we actually believe that that may actually result in more accidents and deterioration in road safety. So that's number one. We also believe that there's some challenges with the way the grid steps operate, and there's some ambiguity and some complexity with that, and we would support having a look at how the grid steps work to make them more aligned to the risk that that driver presents.
Thank you. Jamie, any questions? No. Jay? Bill? Thank you so much for being here. With that, we'll move on to Intact Financial Corporation's presentation, please. Thank you, welcome, and when you're ready, I'd ask you to introduce yourself for the record, please.
Good afternoon, and thank you for having us here and allowing Intact Financial Corporation to present our thoughts and our perspective on some of the varied issues that are present here in this ever-evolving market that are impacting Albertans. So my name is Patrick Magnuson. I'm a Director of Corporate Personal Lines Underwriting for Intact Insurance. And joining me today are Guillaume Benoit, who is the Director of Pricing for Personal Lines in the West for IFC, which would include Intact Insurance, Novex Insurance, and Bel Air Direct. And we also have Tracy Kavitz, who's the Director of Claims for the Western Division for IFC. So today we're going to provide the board with some comments on the state of the market and the subsequent impacts on Albertans from a pricing and coverage availability perspective. We'll also make a few comments on the findings of the Oliver Wyman report. We'll give a few thoughts on some of the short-term actions that we believe should be implemented after the very imminent expiry of the 5% cap. And while today there's been a lot of discussions on the cap and a lot of discussions on the short-term actions that should be taken afterwards, and listen, we support these in general, but we also want to take this opportunity to look a little further down the road and highlight some of the longer-term items that we think can take some of the costs out of the system, leading to more accessible and affordable coverage for Albertans, to improve their customer experience, and to ensure that we collaboratively work together to tackle some of the emerging societal trends. So some of that will piggyback on what Celeste mentioned in the IBC presentation earlier this morning, but we might bring up a few more of those action plans in detail. So with this, I'll pass it over to Guillaume to highlight the results.
So thank you, Patrick. I'm very happy to be here today to discuss with you what solution we can implement to help Albertans have easier access to their insurance product. So on the first slide, no surprise, we see that it's unfortunately a very similar story as of last year. So on the left chart, we see that the industry loss ratio for the 5 years for Alberta have been above 80%, and on the last 3 years above even 85%. So it's quite concerning and much above what other big markets in Canada have been experiencing in the last few years. On the right chart, what we show is we contrast the loss ratio, the gray bar, with what would be the permissible loss ratio in the ideal environment where the industry in average meet the 7% underwriting margin, and where we would have the average expense as per Oliver Wyman graph. So we see that not only in every individual years, we see that on every individual years there is a significant gap to attain rate adequacy, and with no sign of slowing down with 2019 Q1. On the next slide, a very similar take. It's just to contrast also what the average written premium have been in by year, the increase by year that we've seen, versus the red line, that is what would be the rate level needed to achieve rate adequacy with the current product definition and everything. So this is definitely not a suggestion for us that we should take more than 20% rate increase like right now. What we think is just to emphasize that right now the level of is quite unsustainable for a few years, and that with the current product, more needs to be done than rates to resume to an Alberta market of profitability, and then to help Albertans down the line. So more than rates need to be done. The next slide. So we've been reviewing the Oliver Wyman reports, and more specifically in regards to trends and loss selection factors. So and with our internal data, we've been in agreement with most of their findings. So we agree with their reports, and we don't have any concern with them so far. So that's good. So as I said, more needs to be done to return to a competitive marketplace where our industry is looking to grow. So a bit more than rates are needed. So I will leave my colleagues to discuss a bit more about that.
Thank you. Short-term actions, this might be a little bit lofty. It's a bit of
duplication to what we've heard from some of the other groups that are here today. What we'd like to see is around the minor injury regulation, the changes that took place in June of last year. We haven't really had an opportunity to see what these changes will translate to for us. We've had a very small number of files that are represented that have actually been able to settle. So we do remain optimistic that these changes will have positive impacts for us. In addition to that, we do definitely support CEs becoming binding where we're dealing with a true minor injury. The benefit of that, of course, is reducing the battle of the experts that we often see when we have these smaller claims, and it would reduce the legal expenses as well. If we look at prejudgment interest, again, we'd heard some discussion, I think it was from IBC. We definitely support moving to a model similar to Ontario, what they did in 2005, where we follow the Bank of Canada rate for our injury claims. And around the telematics, this is a really great opportunity, and I think we saw that there's an appetite for Albertans to take more of an active role in being able to track their own driving habits, looking at things like distracted driving, and finding a way to charge premium that's more fair based on good driving habits and incentivizing people to do a little bit better. Patrick?
So our next topic is also to discuss the regulatory framework that there is right now in Alberta and how we see it evolving in the future. So right now in Alberta, we need to seek approval by the Automobile Insurance Rate Board before implementing a rate change. But there is also a different office, the Superintendent Office, that regulate which rating variable, that regulate among other things which rating variable are approved or not to be used in rating. So if an insurer is willing to innovate and try a new rating variable, they will need first to seek approval from the Superintendent Office about whether or not they can use this rating variable. And then once they receive this approval, if they receive it, they will have to take that to the Automobile Insurance Rate Board and then see if they seek approval with another layer of analysis there. And finally, once they receive the approval, they will be able to implement it. So we don't think that this process is we don't think that this is optimal to stimulate as innovation as it's possible in the insurance market. In a less regulated market, we have seen more options being offered to customers in regards to rate, but also distribution of the insurance product or other innovations such as risk mitigation measures. An example within IFC, we've been waiting for more than a year now to implement an improved version of our UBI program. This improved program would allow a bit more risk mitigation with the monitoring of at-risk driving habit and then providing insight and education to the customer, to the Albertan drivers. But while we are waiting on various layers of approval in Alberta, we've been able to implement successfully those innovations in other Canadian markets, and we are already in the mindset of implement and improving continuously our product offering. So some studies also with regards to our UBI program suggest that with the feedback we would be providing to the customer, that would reduce the number of claims frequency that will eventually avoid crash, and also like all the negative impact for the customers of being involved in a crash, and that would ultimately result into savings into the marketplace that will end up in lower premium paid by the everyday Albertans. So the less regulatory hurdle, and the more I think it's easy to continuously innovate and try new things and improve on our offer. But what can be done? So we believe that an initial step in the right direction would be to evolve the current prior approval filing to a file and use system. Under this system, insurer would still have to file a proposed rating or underwriting change, but the filing will be deemed approved after a certain period of time. The next evolution after that will be use and file framework. So at the end of the day, what this would allow is also to be more responsive when there is market condition change, to be able to implement the change in matters of days instead of months. Albertans would then benefit from the changing circumstance that can drive down costs, so ensure a smooth incremental change rather than large spike when it's too long, and then you have a more drastic action to take if it's been a longer time. Better competition will lead to more innovation, more price option. So that will allow Albertans' customer to be in the driver's seats in placing their business with the carrier that offer the best value for them. Another recommendation is also to introduce the CPD.
So we certainly didn't get into this situation by just any one issue on its own. There's a myriad of different reasons why we are in this boat, and there's a lot that we can do to change it as well as just ask for rate increases. One of the things that we really like the idea of is moving to a direct compensation model. And take this. So this would give us the opportunity to have a closer relationship with our own customers. We deal with them strictly, I think as it is right now, about 15 to 20% of the claims our adjusters deal with are third-party claims. We'd rather take our expertise and work directly with our own customer. It takes a lot of paperwork out of the system, reducing the time it takes to settle. We avoid long liability disputes. It also has the potential to really take the whole subrogation piece out of the mix and reduce the overall handling time for a claim, money to the customer faster, less litigation involved, just a more streamlined approach in general. It increases the efficiency and cost predictability in that when we're dealing solely with our own customer, we know their driving history, we know the vehicles that we're insuring and dealing with. There's a lot less surprises than we see in our current tort model.
All right, and the final piece we want to talk about is adaptation. So maybe it's important to get this statement out of the way, but we have to acknowledge that climate change is a reality. So the frequency and severity of catastrophic events is increasing significantly, and it's having an impact on Albertans. It's having an impact on their possessions, their investments, their livelihood, and their overall quality of life. So while we might not be able to directly affect climate change in the short term through our actions and our policies, we do believe that we can ensure that we can avoid or at least mitigate the effects of climate change on Albertans and their communities. So Intact Financial Corporation, we've partnered with the University of Waterloo to establish the Intact Centre on Climate Adaptation. And this is a nationally focused applied research centre within the Faculty of Environment, and it works with homeowners, communities, governments, and business owners to identify and reduce impacts of extreme weather and climate change. So to that end, we recommend partnering with the government to develop a climate change adaptation strategy to ensure preparedness and resiliency in the face of extreme weather. So we're currently working with the Government of Ontario on developing such a strategy, and we envision a similar approach with Alberta. I think we have to really repeat that the impact of weather-related cat events and the subsequent insured, non-insured, and economical losses is a significant burden on Albertans. And we need to work together to create an environment where the impact is reduced. In reality, climate is changing, Albertans are suffering, and we need to do something about it. So over the last few slides, and of course in a lot of the other presentations today, we've spoken at length on some of the short-term and long-term visions to improve the current environment and create one where companies want to invest and want to come up with innovative products and solutions that will benefit Albertans with fair and affordable options. But we also recognize that it's a fluid situation. And as we start to address one issue, others will emerge. So particularly as we gather more and more data and we assess the impacts of these emerging trends. So whether it's for instance, the impact of cannabis on driving experience, or the continued, I don't want to say nemesis of distracted driving, but the impact that it has on reality, or even the impacts on our traditional rating algorithms and variables on things like positive societal changes, like finally and fully recognizing and respecting people's identity. So all of these items, they exist, and we need to remain open to change from evolving technology and society, make sure that we support innovative solutions. So it's our hope that the regulatory environment will adapt as well to support this innovation and investment, creating reasonable long-term solutions that fairly cover, compensate, and care for Albertans. So to wrap it up, as an industry, because we aren't in this alone, we have to find a way to leverage opportunities and address the challenges that we face. We have to ensure that ultimately our customers, Albertans, are benefiting from insurance that meets their coverage needs and is priced fairly based off of their unique driving habits and individual profiles. Thank you, and we'll open the floor to questions.
Thank you very much for your presentation. I'll ask members of the board if there are any questions. Chris, any questions? Any question?
Push the button. Thank you. Two of mine, and one's the grid. I don't know who wants to answer. You didn't talk about the grid, but I assume it's on your mind. You have a quick answer for that, and then I have another quick question.
Sure. I mean, I think similar. We agree in general with a lot of the statements that were made today. The grid is, we believe it serves its purpose of protecting vulnerable customers, so the newly licensed drivers, young drivers new to the country. But at the same end, it's a bit too much of a blunt instrument. And by protecting them, we're also protecting drivers that, through their own actions, are basically being rated better than they should be. So we're end up subsidizing those poor drivers with good drivers. So we do believe there's some concerns with the grid and its current structure. And through many of the other conversations that were had today, we were in support of a lot of those changes.
Okay, thank you. And you talked about DCPD. I think it's operating in Ontario. Okay. Have you any idea of the impact by implementing that, of a financial impact in the way of percentage or potential percentage that may be gained on a rate level from implementing DCPD in Alberta?
No, I haven't put together the numbers on that. We're just more looking, thank you, just more looking so at the ease of doing business and sort of more discussing the theory and the philosophy of it before putting the numbers piece together.
Is there an impact? Is there a potential impact?
Yes, yes, absolutely.
Financially, I'm talking.
They're definitely, it doesn't want to stay on. Oh, you're shutting me off. Okay. There definitely is a financial impact. However, we believe that it's a positive impact. We believe it has the ability to reduce the number of staff that we're working with. And realistically, I think the philosophy is everybody looks after their own and it all comes out in the wash. As a larger insurer, we certainly have the potential to lose the money on the subrogation side, but we think that where we'll get the lift from the staffing perspective and paperwork perspective and reducing the effort is going to offset that.
Or more than offset. We don't have a specific quantification analysis to provide, but it's going to, for sure it will remove a burden in the market with shorter settlement and less money spent in others than repair for customer.
Thank you very much. Jamie, any questions? No. Jay? Bill? Covered? Great. Thank you so much for your time today. With that, we'll look for our final presentation today from TD Insurance, please. Whenever you're ready, I'll ask you to introduce yourself for the record, please, and take it from there.
How it works, so I was just trying to make sure I had the right button. So thank you. We appreciate you saving the best to last. So my name's Lynn Whitehead. I am the Director of Government Relations from TD Insurance, and with me I have two wonderful individuals who are going to speak about their respective areas. Jonathan Boucher from pricing, and I've also got Thomas Carbone from our resident attorney here in Alberta. So you've heard a lot from a multitude of stakeholders. So I'm not going to get into a lot of the same costing trends, same costing pressures that you're used to of hearing for the whole day. What I am going to say is we're going to actually delve into a little bit more specifics, potentially on an area that has not been looked at as in depth, but we think that with this new government and with your assistance, we might be able to socialize this out, that there's the ability for us to reduce some cost pressures and some expenses in our industry. So before we get into all of that, I am just going to give you a bit of flavor of TD Insurance. We are the largest direct writer in Canada. We have an extremely large footprint within the Alberta market. And we are also an entity of TD Bank. TD Bank is one of the sixth largest bank in North America, I should say. And we are a trusted bank brand both within the Canadian and American markets. We've won a number of awards, and we consider ourselves to be one of the best places to work. As I said, we've got a number of different strategies, but one of our biggest strategies that we've got is creating that end-to-end experience. Our ability as, I guess, one of the largest insurance companies, we don't deal with brokers, we deal directly with the public. Because of that, we're able to offer an experience both at the front end of when you are coming in, having a quote, getting your insurance products for both your home and auto, and we're able to individually match the coverages to your own needs assessments. And on the back end, should you be unfortunate and suffer a loss, we actually have developed out these claims type experiences where we have a one-stop shop known as our accident comfort centers, to which we do have 6 in the province of Alberta. And they are a one-stop shop where you can not only get your vehicle repaired, you can have it appraised on the spot, you can pick up a rental vehicle, and you can have all of your needs met within a one area preferred shop vendor. However, of course, you always have the right of choice, so this is just an option for you, but it is another way in which we're looking at that full breadth of providing the best customer experience possible. So as I mentioned, we do have a very substantial footprint in Alberta, one to which we do want to protect, one to which we do want to continue looking at organically growing. So we are not here to ask for or put forward ideas of having significant rate shock spikes. We currently have a rate footprint of 15.5% of the market, and we are the second largest insurer within the province of Alberta. I'm now going to turn it over to Jonathan, who's going to speak to some of, I guess, the observations.
Okay. So again, thank you for your time and for the opportunity of being here today. We understand that the insurance market is going through a really hard time at the moment, and we understand that we have a pretty important role to play. So that's why we're here today. That's why we collaborate with all stakeholders in the objective of bringing the market in a better position as quickly as possible. So as we went through a full day of presentations, I'd like first to just echo with all or most of the presenters today on what are the main drivers of the instability in the market right now. So first, the more severe winters we are facing and the frequent severe weather-related events, the continued pressure on claims due to the minor injury cap erosion, the judicial process who impact the claim settlement, the current economical context in Alberta, and of course the ministerial order who limited the rate increases to 5%. So these are well-documented observations, and as we went through all of these during the day and even the last years, I won't spend much more time on describing each of them. But still, we thought it was important just to echo with all the others on these are the main drivers who negatively impacted the profitability in Alberta during the last few years. Thanks. So in terms of historical return, below, I'm just sharing the same graph as we've seen a couple of times today. You have the historical loss ratios for the province, and based on the benchmarks for profit provision and expense ratios, we can see that since 2012, the industry loss ratio has been well above the targeted loss ratio. So on top, you have the other chart which represent the yearly average premium change from the industry. So we can see that the industry has slowly increased rates over time in response to the negative profitability. But since these rate changes were not sufficient, and while the internal initiatives to fix the profitability is now exhausted, the industry was left with no real other choices than starting to increase more significantly rates in 2017 and 18. So this is what we're starting to see there. But at the same time, this is when the ministerial order came out. So unfortunately, this had the impact to force some private insurers to take less customer-friendly actions, just to resolve the unsustainable premium deficiency they were seeing. So that's kind of the same picture as we were seeing previously. So where these costs are coming from? So on the left side, you have a chart with many curves. You see all the claim variations per peril based on Oliver Wyman's report. So each years are compared on a relative basis on 2010. So starting at 1 in 2010, we can see that bodily injury loss cost, which is represented by the blue line, has almost doubled in the last 8 years. If we focus more on the last 5 years, BI claims has increased by 30%, accident benefits by 60%, and even theft by 95% over just the last 5 years. And that's for the entire industry. So without giving too specific proprietary information, we wanted to share how TDI's loss costs compare against the industry. So on the right-hand graph, you have the total loss costs from Oliver Wyman's report, which is just the combination of all the curves represented by the black line against the TDI's data, which is the green one. So we can see that from 2010 to 2018, there's quite a little bit more volatility in TDI results. And yeah, obviously, as we are a large insurer in the province, we do have an impact on overall results. But still, we thought it would be interesting to let the board knows on how the TDI loss cost is well aligned with the rest of the industry. So then that was the past. So how this translates to the prospective view for 2020 and 2021. So both Oliver Wyman's data and TDI data clearly indicates that the loss trends are positive for all coverages. So with no real change in the industry, we can assume that these trends will continue in the future. So as I shared earlier, the main drivers of the sharp increase is BI, accident benefits, and theft. So yeah, so again, as TDI results are really comparable with the industry, our selections per peril, even if it's not exactly the same as Oliver Wyman, are really well aligned. So more precisely for BI, our selection is 7.3 versus 7.5, accident benefits 10 versus 9.5. So overall, few discrepancies here and there, but we are in agreement with what has been selected. So such high loss trend on a prospective view, combined with an actual premium deficiency, will for sure continue to put a lot of pressure on future profitability, on rates, and ultimately availability for the customers. So what can we expect next year following the rate cap expiry? First, rate adjustment is required short term to limit the underwriting losses, to ensure insurance availability for the population, and of course account for the persistent loss trends we are seeing right now. But that being said, at TD, we always think to the customer first. So that's why our principal guidelines for any rate changes or any action we may take that will have an impact on the customers is always designed to ensure availability, affordability, fairness, and stability. So in light of current profitability and future profitability, still we understand that the premium adequacy will not be reached only through rate increases. More structural changes, better controls, and product revision will be required to make sure we can have a more healthier insurance market. So that's why we support and will continue to support all stakeholders in finding the short to long-term initiatives we can implement. That's it.
Thank you, Jonathan. Thank you, Jonathan. So now we're actually going to turn this over to Thomas, who's going to talk to us about some of the other additional factors that I'd alluded to that are contributing to the cost pressures.
So throughout the day, we had the IBC make reference to the BI problem. And we've had others talk about the BI issues. We've had reference to the fact that BI claims aren't up in the last 4 years and that we're somehow paying less. We're not. The cap, when it came in, immediately prompted a response from those who practice in that area to see how we can undo the cap. And those lawyers doing that work do a very good job at it. Sparrowhawk is always pointed to as a significant decision. It's the short edge of the wedge. It started the process. And it had its effect, and it did diminish the interpretation of the cap. But since then, other decisions such as Jones-Stepanenko and importantly McLean and Parmar have been very significant. They've led to a significant increase in claims that are outside of the cap. We settle far less files, as I think Aviva referred to and Intact referred to, than we did before within the cap. Expenses have gotten much higher. The opposing counsel are putting much more effort into seeing those claims come outside the cap, less with TMJ now, and was as referenced before, concussions and psych evaluations, things of that nature. Far more often, we're seeing files that would otherwise appear fairly minor, where there's still a psych report on the file. The psych report may not say anything, but at the end of the day, we're asked to pay those disbursements. Right? The bill of cost comes to us. The settlement is plus interest, plus cost. Interest is extremely high. PGI is extremely high, as we've noted. And we're paying the costs of all these expert reports. In many instances, the expert reports have become very, very, very significant in terms of cost, not necessarily so much in terms of adding value to the evaluation of the claim itself. The minor injury definition was revisited to some degree with respect to TMJ recently. As we've noted and as we've seen in other provinces, particularly in Ontario, all that leads to then is renewed effort to find the other avenues that are going to go around the cap. If we look at it, again, we see more reports with respect to chronic pain, psychological impairment, things of those nature. In McLean and Parmar, which is the one everybody rightfully refers to, because within what we do, it did have a relatively chilling effect to read that decision. Madam Justice Eidsvik did cite medical studies that noted pain that lasts longer than 3 to 6 months is classified as chronic pain. What that means to insurers is very, very few files now are going to fall within what would otherwise have been a capped claim, or it would have fallen under the regulations. The other side of it is even in instances where it's just a WAD 2, and we have gone to trial on a few occasions, relatively few, which I'll get into shortly, the damages at trial are tremendous. I've noted a couple of examples with respect to the erosion, and WAD 2, chronic pain, general damages, $75,000 reduced to $60,000 for failure to mitigate. That's Stevenson and Thompson. Housekeeping awarded as a lump sum in addition to general damages. That's Jones and Stefanenko. Loss of earning capacity is awarded in almost every case, and often 1 or 2 years of gross income. In the Chisholm decision, there was a loss of earning capacity in addition to a loss of competitive advantage, which I believe was 1 year of gross income in that instance. The other option, of course, everybody says, take it to trial. We'd love to. We can't get there. It's very hard to get there. The other problem becomes in instances where we do get there. Recent decisions, Petz and Duguay, which is a 2017 decision where the court concluded that Mrs. Petz was not credible, yet still awarded general damages of $50,000. Bumstead and Dufresne, Calgary decision 2015, the court noted that the plaintiff's credibility had been seriously compromised and concluded that the plaintiff was not credible, yet still awarded $50,000 in general damages. And these damages are all still in addition to PGI running back from the date of loss to the current date, which by the time we get to trial is often as long as 10 years. This leads me to our observations pertaining to the judiciary process. Understanding the scope of this board, I think Mr. Daniel asked before what was our ask in terms of these areas. We appreciate that it's not your decision to make, but we do appreciate also that you may be in a position to echo the recommendations of the bar and others that we need more judges, we need more courtrooms. There are a lack of justices in the province. Civil trials are rarely being held at the moment. There's a lack of physical space in Edmonton, Grand Prairie, and Fort McMurray. Prior Chief Justice Whitman noted this. Our current Chief Justice has noted this. It's a problem. Getting a trial date is a problem. Getting a JDR date is nearly impossible. And the solution is, we're being told, well, go to mediation. That sounds great. The problem is that now we're going to mediation on relatively small files, and we're paying for a mediator. The insurance company is going to pay one way or another. Even if the plaintiff splits it, it's going to be on their bill of costs. So we're going to pay $5,000 or $6,000 for a mediation on top of what we're paying for the claim. The other side of mediation is it's been our experience that claims don't typically resolve cheaply at mediation. A JDR, you get the opinion of a judge who tells you what your claim is worth. At a mediation, it's a little bit more of a, let's just get this done, guys, before lunch or before the end of the day. It's not necessarily an effective way to go in all instances. In some instances, it certainly has its place, but it doesn't replace JDRs. It doesn't replace a judge telling my client in many instances, you're wrong. This is the way we would look at this, or this is the way one of my brethren would look at this if this were to appear before us. The other solution that's been proposed, other jurisdictions have other ways of setting trials. There's trial sittings in Ontario. Our suggestion there is that part of what may need to be done is we have to look at the way our civil trials are dealt with and our trials are set, in addition to, no matter what, new judges and new courthouses. Disbursements, beyond the mediation disbursements, I made reference earlier to the expert disbursements. We have had bills of cost where disbursements have been in excess of $200,000 and approaching $300,000. There are very, very significant disbursements. There's many instances of multiple experts and other very high disbursements. It's not all counsel, but there are a number of them, and it does have an impact. It has an impact when a very basic claim that may settle for a relatively nominal amount, they still went and got a psych expert, and they still went and got an orthopedic expert in what might have been a relatively resolvable claim and may still be. Those disbursements are adding up significantly. We've seen a dramatic increase in our disbursements previously and since McLean and Parmar, because there's greater effort in making sure that these files don't fit within the cap. The other suggestion that was made is perhaps the current system forces plaintiffs, lawyers, and us to get our own experts. Perhaps a solution such as making CEs binding in certain situations might be helpful in that instance, but there does need to be something done. We get to the stage where we're getting, even as we get toward a trial, we will get multiple expert reports coming in and new expert reports. And we don't often have the time to send that plaintiff back to our expert, or they'll get the two experts on the same subject matter, two orthopedic experts. Those disbursements, those expenses, mediations, those are making our claims significantly more expensive, in addition to which the claims are becoming more expensive. There are many more claims that are outside of the cap that we're seeing on a regular basis. All of these factors contribute to longer cycle times and increased claims costs. Our files take longer to close. The longer they take to close, the more money they cost. It's not just to the detriment of the insurance company, it's to the detriment of the plaintiff or accident victim. If a matter is not going to get to trial until 10 years after it happens, that's not good. Plain and simple, people that are injured should get their money much sooner. We should be able to resolve those claims sooner. And if I can't agree with the plaintiff lawyer, or we can't agree with the plaintiff lawyer, then we should have a remedy to resolve that much sooner than 10 or so years after trial. We've seen BI claims with closed settlements increasing in line with what we're seeing in pending claims. We can see it coming. We're looking at it. We're working hard at it. But I can tell you that that's something that weighs heavy within our office, is the fact that claims are going up and expenses are going up. In the most recent accident year, at 32 months of development, we're seeing the highest increase in average claim settlements. This is true with and without legal representation, although, as was noted previously, legal representation is far more frequent now than it had been in the past. Thank you. Oh, do you want me to do that part?
So in summary, I think we've explored a number of new and creative ideas that have not yet been brought forward with respect to some of the things that have been talked about today, with product reform in conjunction with future rate increases or changes that need to be done. TD definitely supports a balanced approach. Premium levels with an opportunity to further innovate with some of our products, some of our changes within the auto insurance industry. A more gradual approach if we are going to have changes. As I said, we are not agreeable to high rate shocks or high rate changes, whether that be from the drop of the ministerial cap or from the change that has been discussed in the, I believe, the 10% but the 10% AIRB cap, and any additional rate increases that are required to keep our rates aligned, are done so with the aforementioned prior claims costs and are a temporary measure. They are not one that is going to be a long term. So we'd like to thank the board for being able to present to you today and are open to any questions.
Thank you very much. Jamie, I'll start with you. Any questions?
Nothing mean, though. It's too late.
You're on.
Tom, you talked about a remedy just as you're wrapping up there to expedite the process and to smooth out the bumps and turns along the way in smaller and larger cases. What would be your solution to that?
Well, one of them is, one of the remedies that was proposed is trial sittings, which we don't have, right? Which you're probably familiar with it. But for those who aren't, effectively there's a sitting, Ontario does this, there's a sitting, I think they do theirs, I can't remember if it's quarterly or monthly. You're given that day, you have to show up ready to go to trial, your name comes up, yes, we're ready to go to trial, there's your trial. You're not ready to go to trial, you fall back of the list. Whereas in our situation right now, we're setting trials, I don't know, what are we, 3 years plus out now in both cities, I think? Yeah. So that was the one that was recommended as far as smoothing out the process. We hadn't really looked at the idea that had been proposed or any of the other ideas that are proposed, other than perhaps the binding CEs on smaller matters might make some help. Other than that, more judges and more courtrooms.
Thank you. Jay, any questions?
I appreciate the last point of your conclusion. You know, it looks like a strategy to be proactive beyond just, you know, rate changes. Since it was mentioned in IFC's presentation, with respect to fundamental reform changes, I'm just curious about TD's perspective on DCPD. Would you be willing to comment on that at all, or?
Yes, so we are a big supporter of introducing DCPD into the province. I believe that it would have tremendous benefits, not only from the insurer side, but really so much from the consumer side. Taking the complexity of only dealing with your own insurer, reducing the wait time for treatments or for receiving any sort of physical damage coverage for your actual vehicle, as well as from an insurance perspective, from an administrative side, it really does reduce that, because you no longer have to have the subrogation between the insurance companies or wait for a third-party insurer. We can deal with that aforementioned after.
Thanks.
Bill, any questions?
Oh, I'm fine, thanks.
Chris?
Thank you. We've heard a lot today about different concepts, different ideas. Certainly what I'm picking up is that there's no quick fix. Okay? You've brought to the table the judicial system. We've heard about DCPD. We've heard about changes in the MRI, the cap. So if you were to sort of come back and say, okay, is it potentially possible to do a short-term fix with a long-term view? That's point number one. And point number two, what would be your priorities in coming back? You've suggested that we're in a problematic, I don't want to use this word crisis, but a crisis mode. So with that in mind, what would your two answers be in that respect? Thank you.
Do I have a priority? I'd like to see them all done now. I think, you know, I will refrain from using the word crisis. I think we're at a critical juncture right now. I think that we are in a time of an opportunity where we have a government that clearly has an appetite for change. Will there be short-term measures that must be introduced with a long-term visionary goal? Yes. Will tweaking work? No. We've seen that in even some of the presentations today of where we have made some changes, and over the 15 years that tweaking has clearly not made or resolved the issue. Same thing with the ministerial cap. We would have been better off probably making some more substantial changes than introducing a cap that just suppressed rates that now has the likelihood of introducing much higher spikes than what we would like to see, or what any insurance industry would like to see. I think short term, we are working through our various associations, trying to come up with a variety of different options that the government can introduce that will help our the many drivers of Albertans, but also help the industry. And it is not our intention in any means to do something that's going to be beneficial for one stakeholder versus another. I think that this is a collective resolve, and it is something that needs to be looked at closely, and that's why we're happy to have AIRB as an ally. It's why we have brought forward some of these ideas that are not necessarily within your scope or your mandate, but you could definitely help by supporting us in some of our advocacy efforts moving forward. Yes, there might be some opportunities, maybe with the grid that's been mentioned here today, looking at some revisions to that is within your scope. maybe looking at some opportunities for introducing some short-term or some what I call short-term, which would be an easy tweak of introducing DCPD into the product. But I know that there are other regulatory changes that have to be made or legislative changes in the processes that are needed to go through. But short-term versus long-term, I'd like to see it all now.
Thank you very
Thank
much.
you.
Thank you so much for coming in today and for your presentation.
Thank you.
That concludes our presentations for today. I would like to take this opportunity to thank Lori Balfour and her staff for pulling everything together so that we could go through this this open meeting. It takes a lot of effort and coordination, and it always looks easy because they do an excellent job. So thank you very much for that. On behalf of the AIRB board members and staff, I would like to extend our thanks to everyone for attending and to those who took the time to provide written submissions and make written submissions to the AIRB today. We will be taking that information that was presented and into consideration as we deliberate the setting of industry benchmarks, which will be used in our review of insurer rate filings effective October 1st, 2019. Today's presentations will be posted on our website, www.airb.alberta.ca, following today's meeting. As well, a recording of today's presentations will be available on our website no later than August 31st, 2019. I know you're all going to hold your breath until that date, but hang up. Following today's meeting, the AIRB will consult with our actuary, Oliver Weinman, to determine any additional information that may be required to finalize our 2019 annual review report, which must be posted to our website no later than September 30th, 2019. In addition, the information gathered today will also assist the AIRB in setting the grid entry-level rates effective January 2020. The grid, of course, establishes a maximum premium for basic coverage for all driver profiles and protects drivers from rates that may make insuring a vehicle prohibitive. Again, I'd like to thank each of the participants for assisting us in gathering information and data to support our decisions. We do appreciate it. And with that, I would call this meeting adjourned. Have a great day, folks.